Hi everyone, welcome back to Saheb Academy. Today in this video we're going to start this new chapter of CA Inter Advanced Accounts, Cash Flow Statements, and we are also going to cover AS3. Okay, so understand this chapter is not a difficult chapter. I would say it's a medium chapter, right? Because understand in CA Intermediate you have lots of adjustments, right? So you will be able to do those adjustments only when you understand the basic silly things about this chapter, the basic things which all the teachers might not teach you, and that's what I'm here for. I will teach you every silly things that you must know so that you can perfectly answer the questions of cash flow statements. Okay, so that is what we're going to do in this video. Bit by bit we are going to cover everything, and then in the coming videos we'll solve problems. Right now only the concept, the technique, the format, and all the silly basics that you must need for this chapter. Okay, that's what we're going to cover. So let's start and let's understand cash flow statements. Now before moving on to the concept of cash flow statement, first let's just talk about the scope of applicability, because it's very important. If you're studying something, then you need to know to whom it's applicable, to whom this accounting standard is applicable. So that's what we are going to understand. See, AS3 says it is mandatory for all enterprises to follow this accounting standard except small and medium companies, SMCs. And if you're talking about non-corporate, then you all know that non-corporate entities are divided into three different levels for applicability of accounting standards: level 1, level 2, and level 3. So level 2 and level 3 are also exempted, non-corporate entities, but level 1 has to follow. They have to apply this accounting standard, and as well as non-small and medium company. Okay, they also have to prepare. But this is what small and medium company, these are the ones that are exempted. Is that clear? Fine. But what the Companies Act says, Companies Act says all the companies must prepare the cash flow statement except one-person company, small company, dormant company, and private company, which is a startup. Okay, only for startup it is exempted, but it is recommended for all of them to prepare cash flow statement. Is that clear? And then SEBI talks about listed companies that they have to follow a certain method to prepare cash flow statement. Don't worry, we will learn this method and everything. Just understand that listed companies have to prepare the cash flow statement by indirect method. Okay, right. So this was the scope of applicability. Is it clear? Now let's get back to the concept of cash flow statement. Now see, here we have the concept of cash flow statements. It's really simple. First, you need to know the meaning of each of these three terms properly. Cash doesn't only mean hard cash. It means a box of three things: cash in hand and cash at bank or any financial institution, and it should be repayable on demand. If we go to the bank or that financial institution, immediately we should be able to withdraw that into hard cash. Okay, and then there is cash equivalent. What does that mean? It means any short-term investment that is equal to cash. Is that clear? Now what does that mean in detail? We'll discuss. Okay, so just understand, cash doesn't only mean cash, it means a box of three things. Is that clear? Okay. And then what do you mean by flow? Flow means increase or decrease. Okay, or I can say technically in the language of this chapter, how cash has been generated and cash has been utilized. Is that clear? How it has been generated and utilized. Fine. That's what flow means. Changes, increase or decrease. Statement is summary. Okay, so cash flow statement is nothing but a summary of cash flow. Fine. Now if you can see over here, I have made this diagram of a statement in which I have three colors over here. Why three different sections I have made over here? Because understand, in this cash flow statement, the cash flows, the inflow and the outflow, right, the receipt and the payment, these will be classified into three different activities: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. We'll study about them in detail. Right now I'm just giving you an overview. And then at last in the cash flow statement, what will be there? There will be the balance of cash balance in the beginning and cash balance at the end. Okay, don't worry, I will show you the format, everything we'll discuss. Right now you are just getting an overview. So the company will prepare this additional statement along with balance sheet and statement of profit and loss, right? And it will be given to the users of financial statement. For them this is prepared. Why? So that users of financial statements can understand the company better. They can understand how company generates and uses the cash. Okay, what's the source of the cash and how this cash has been utilized in the company, and they will be able to determine the future requirement of the cash. Okay, and they will also come to know whether the company is able to generate the cash or not, right? So based on all of this, they will be able to make an assessment that's called as liquidity and solvency assessment, which is very important. Now what is this liquidity and solvency assessment? Understand, liquidity means the company has enough cash to pay its short-term expenses. It can meet its short-term obligations. Company can survive. Okay, and solvency means what? Solvency means, the company can pay its debt when it falls due. For example, if the company has taken loans, company has raised money by issuing loan notes or debentures, then when they will mature, it has to be repaid, the money, isn't it? The loan has to be repaid, the debentures needs to be redeemed. So if the company is able to do that, then that's called the company is solvent. If it can't, then the company is insolvent. Is that clear? Right. And you need to understand how important cash is. Even if the company is earning profit, that doesn't mean the company will survive. The company is liquid and company is solvent. No. Even if the company is making profit, still the company can go bankrupt. Why is that so? Because understand, cash is the blood of any business. See, cash is very important. If you want to operate your company, you have to pay salaries, you have to pay all the utilities bills, the overheads, the rent, electricity bill, the fuel expenses, the transportation expenses, advertisement expenses, all these expenses you have to incur, right? You have to purchase the supplies, isn't it? Then only you'll be able to operate your business. And then you have to pay your obligations as well. If you have taken any liabilities, any bank loan, all those also you have to pay the liabilities whenever they fall due. Otherwise, they can take your company to the court, the creditors and all, right? And then you have to provide return to your investors. You have to pay dividend to your shareholders, and then you have to pay interest to debenture holders if you have raised money through debt, isn't it? And then you have to expand your company as well. You have to purchase non-current asset, you have to open new divisions, you have to grow your company, then only your share price will increase, isn't it? And you have to make overall profit also. To make profit you need cash, otherwise you can't run your company, believe me. Okay, you must have watched Shark Tank, right? On there, the entrepreneurs, they come and they say that they don't have runway, right? What does that mean? They don't have cash. They have just 6 months of runway left, 3 months of runway left. What does that mean? It means they don't have cash, right? So cash is very important for the company to survive. So that is why, cash flow statement is prepared so that the users of financial statements can see how well the company is performing. From the statement of profit and loss, the users of financial statement will understand only the profitability of the company, not the liquidity of the company. The liquidity of the company will be only understood when they see the cash flow statement. Is that clear? Right? Let's just take a simple example. Let's just say you have opened a new shop. Okay, today you started the business. Let's just say first customer came and you sold, let's just say he's your friend only. You sold him on credit. Okay, you sold him on credit the goods, and let's just say you have made a profit of how much? 10,000 rupees. Okay. So let's just say immediately you're preparing income statement. I mean, you're not preparing income statement, but imaginary, let's just say. If you're preparing income statement, statement of profit and loss, then you're finding that on accrual basis, you have recorded your friend as a what? As a receivable, and you have recorded the revenue. You have got the gross profit, then the net profit. So the profit is 10,000 rupees. So if you open your cash drawer, do you have 10,000 over there? No, you don't have 10,000. 10,000 you will receive after a month or so, isn't it? When your friend will pay you. Right now you don't have any cash, but you have a profit of 10,000. What is that profit? That's just book profit. just on accrual basis. You have to understand, statement of profit and loss, income statement is prepared on accrual basis, and cash flow statement is prepared on cash basis. So if you prepared your cash flow statement, then no cash flow has happened in your business. There is no inflow of cash, zero cash you have. Do you understand? Let's just say your father comes and he asks you how much you have earned. You will say 10,000 profit I have made, I have sold this, but you don't have anything to show, isn't it? You don't have any cash to show to your father, right? Do you understand? That's the thing. Okay, so that's why cash flow statement is very important. Fine. Now let's understand the meaning of cash in very much detail. See here, cash means a box of three things: cash in hand, cash at bank or FI, and cash equivalent. Okay, so let's understand this in detail. See here, cash in hand and demand deposits with bank or FI. FI means financial institution. What are these demand deposits? As I told you, if you have deposited the money in the bank or any financial institution and those are repayable on demand, demand deposits, which means if you go to the bank right now, you should be able to immediately withdraw it and get hard cash. So that's called as demand deposits with bank or FI. Is that clear? Okay. So cash includes these two things and cash equivalent as well. What is this cash equivalent? You have to look into the AS3, how AS3 has defined it. AS3 has said that cash equivalent are nothing but short-term, highly liquid investments, readily convertible into known amount of cash and subject to insignificant risk. That's what AS3 says. And short-term means the maturity period of those short-term investments should be less than 3 months or less than or equal to 3 months from the date of acquisition. Is that clear? For example, you have made a fixed deposit of 2 months, fixed deposit of 3 months, then that's a cash equivalent. Why is that so? Because the definition says that highly liquid investment, anytime you should be able to, sell it. Is that clear? And then readily convertible into known amount of cash. So you should be able to know the amount that you're going to fetch in the advance only, because it should have very little risk. It happens in case of government securities. There is no fluctuation at all, right? Very low risk is there. So that is why, it is a cash equivalent. The government security which have a maturity period of less than or equal to 3 months. Is that clear? These two are the best examples. Fine, you understood cash equivalent also. It's really easy. Okay, now let's talk about cash flow. You understood what is cash flow, right? There are two types of cash flow. Either there is cash inflow or cash outflow. Inflow means what? Money is coming in, receipt. Okay, and outflow means money is going out, right? Is that clear? Of what? Of cash and cash equivalent, of that box we are talking about. Of that box we are talking about. Is that clear? Any transaction which does not result in cash flow should not be reported in the cash flow statement. Yes, understand. I told you in the beginning only, cash flow statement is prepared not on accrual basis. It is prepared on cash basis. Any transaction which affects the cash balance, which causes the inflow or outflow, will be shown in cash flow statement. And simple funda is there. Okay, simple funda is there. Remember this, it's a golden tip. Whatever that goes in our cash book, okay, in cash account or bank account, that will also go in cash flow statement. Remember this. Whenever if you are looking in the question and if you feel whether I have to take this or not in the cash flow statement, then just think whether it will go in cash or bank account or not. If it is yes, then you have to take it in cash flow statement as well. Is that clear? Okay. Now depreciation. Now what is depreciation? Depreciation is nothing but what? Decrease in the value of asset, right? We expense the asset. First we purchase the asset, outflow happened, purchase of an asset, that's an outflow. But in the next years, in the following years, 5 or 10 years, we are charging the depreciation. We are decreasing the value of an asset. That just happens in the books, isn't it? In the income statement, we charge that, the asset as an expense, part by part. So it's called depreciation. Because of that, there is no cash flow. No cash is decreasing or increasing because of depreciation. So depreciation will not come in the cash flow statement. Is that clear? It is not a part of cash flow. Is it clear? Okay, so whatever goes into the cash or bank account also goes into the CFS, okay, cash flow statement. And remember another golden tip which you will be able to relate when we'll solve the question and everything. Remember, whole family will sit together in cash flow statement. And let me tell you, there are three families, okay? There is operating family, investing family, and financing family. And remember, whole family will sit together, okay? We will relate to this in the later concepts. Fine. And then one more thing that is very important. Remember, I told you cash is a box of three things: cash in hand, demand deposits with bank or FI, and cash equivalent. This is a box. Understand, any movement that happens among these three elements is not a cash flow. Cash flow is money is coming in the business and going out of the business. But anything that happens within the cash only is not a cash flow. Okay, if you have purchased any asset, then you have paid money to a third party, right? You have paid money to a third party, and that movement is different, isn't it? But if there is any movement within these three elements, for example, you have withdrawn cash, right? So money in your cash drawer has increased and in bank it has decreased. So the movement is happening within the box only. Cash in hand is increasing, demand deposit with bank is decreasing, right? Let's just say you have deposited cash. What happens? Bank balance increases and then cash drawer balance decreases. So movement is happening within the box. These movements will not be tracked by the cash flow statement. Okay, if you have purchased any asset, if you have paid dividend, if you have received rent income, if you have paid rent, these are the transactions which will be recorded in cash flow statement, not this. Okay, not the movement within the box. Movement within the box is irrelevant. Is that clear? Because it's cash only. We have it with us. Is that clear? If you have purchased any cash equivalent, still you are paying the money to the third party, but still understand, cash in hand is decreasing, cash equivalent is increasing. Isn't it? So movement is happening over here only. Increase, decrease, decrease, increase within the box. It's irrelevant. Is that clear? These will not be recorded. This is not a cash flow. Okay, so you have to understand what is a cash flow. Cash flow is inflow and outflow, receipt and payment of cash and cash equivalent, something that should happen outside this box. Is that clear? Simple. Now let's understand classification of cash flows. Now see here we have the classification of cash flows. The cash flows are classified into operating activities, investing activities, and financing activity. Okay, these three different categories are there. Now why do we have these three different categories? See, it's really simple. In the beginning only I told you that, see, whatever that impacts the cash, whatever transaction or event that impacts the cash, which causes the cash flow, receipt or payment, then we have to report that transaction in the cash flow statement, right? So just visualize how many transactions will be there. So many transactions, right? So that is why if we just list them out, plus minus, plus as the inflow and minus as the outflow, then it would not make much more sense to the users of financial statements. It will be same like cash or bank account. So that is why they thought, that we should organize the cash flow statement into three different sections, or informally I call them as three different families: operating family, investing family, and financing family, right? And that's how all the cash flows will be classified. So as you can see, we have three different categories, right? Three different families, I call them: operating activities, investing activities, and financing activities. So first you have to understand what each of these activities mean, okay? Then only you will be able to classify properly the transactions, in which activity they fall in, because that's very important. Okay, so let's see. First we have operating activities. Operating activities means the activities which are main revenue generating activities of an enterprise. Okay, whatever receipts and payments happen to generate the revenue, to do the main operation of the company, those are operating activities. That's number one. And then the second thing is you have to understand whatever transaction which affects the cash and doesn't fall into these two categories, which doesn't fall into investing and financing, then automatically that becomes operating activity. Cash flow from operating activity. Is that clear? Simple. So now let's just see certain examples and you will understand. See here, sale of goods and services. This is main activity of the business, selling goods and services, yeah, generating revenue. So that would be an operating activity. If you have received any fees, royalties, commission, that will also be an operating activity. Okay. And then if you are purchasing, of course you will purchase, right, paid to suppliers of goods and services, that would also be an operating activity. So whatever that is main operation of the business and whatever that is related with that, that would be an operating activity. To run the company, what you have to do, you have to pay the rent, you have to pay the electricity, you have to pay the salaries and wages, yeah, all the employee benefit expenses. All these are what? Operating expenses, which will be operating activity. Okay. Any cash flow happens because of this, whether money has been received or paid related with this, it will be operating activity. You have paid income tax to the government or you have got refund from the government, then that will also be what? Operating activity. Is that clear? Is it simple? But then there are certain taxes which are related with other activities. For example, if you sell a long-term asset, right, a building, and this transaction, selling a long-term asset, a PPE, is called as what? Investing activity, let me tell you. So the tax which you pay on that, the gain which you have made, yeah, long-term capital gain tax, that will also be called as investing activity. Now you'll wonder why. Income tax is operating activity. Why not that long-term capital gain tax also? You have to understand. I told you in the golden tip that the whole family sits together. Long-term capital gain tax is related with the transaction that is of investing. So long-term capital gain tax is also of that same family. They are related. Is that clear? That's how you have to see things. Whatever is related, it becomes a family and it's of investing in this case. Is that clear? The whole family will sit together. The sale of building is investing activity. The tax that is paid, that's also investing activity. Is it clear? Okay. So you understood operating activity and then it will become more clear to you. Okay. Now, investing activity. What is investing activity? See, any outflows to acquire resources, yeah, assets for generating future cash flows and incomes are called as investing activity. For example, you have purchased a building, you have sold a building, you have purchased shares of any other company, you have purchased debentures of any other company, bonds of any other company. You are investing the money over here. So if you are investing, then obviously you will generate income in future, isn't it? Either you will sell it, right? That's different, but that's also investing activity, and you will generate income also, isn't it? If you have purchased a building and just rented it out, then what happens? You will get rent. So that rent received is an investing activity because it's related with the building. Is that clear? Similarly, if you have invested in securities and shares, you will get what? You will get interest and dividend. So that is also investing activity. Dividend received, interest received. Is that clear? See here. Why is that so? Because they are of the same family. If you're investing in shares and that is investing activity, then on those shares, if you're getting dividend, that is of the same family. The whole family will sit together. That's also investing activity. Is that clear? Simple. And then we have financing activity. Financing activity means anything that is related with the capitals and borrowings. If you have issued any equity shares, if you have bought back any equity shares, then that's financing activity. Yeah, because of this cash flow happens. You know, right? When we issue equity shares, what happens? We get money. When we buy back shares, what happens? We have to pay money, and that too very extra money, right? Very premium we have to pay. And then bonus issue. Is bonus issue a financing activity? Tell me. No. Why not? Because in bonus issue, we do not receive any money. There is no cash flow. In bonus issue, what happens? We just convert reserves into shares, right? So it's just a book entry. We just convert the reserves into shares. There is no cash flow. So bonus issue will not come under cash flow statement. Is that clear? Right. And then issue and redemption of debentures or bonds is also a financing activity. Okay, because we are raising finance through debt, and if you are repaying that, that is also a financing activity. And then bank loan, if we have taken any bank loan, then that's also a financing activity because we get money, right? We get finance from the bank. And then we have to repay that also. So repayment of bank loan will also be financing activity. Now understand, if we are issuing shares, what we have to do? We have to pay dividends. So that is related. So that would also be financing activity. The whole family sits together. And then if we are issuing debentures or bonds, then on those debentures and bonds, we must pay interest every year. You all know this, right? We have to pay the interest. So that interest paid will also be financing activity. Is that clear? Simple. So that's the thing. And then on the bank loan also, we'll have to pay the interest. Is it clear? Simple. So these are what? Financing activity. Now let me tell you, for example, let's just say we have given a loan to our employee. We have given loan to our employee. Then what is that? If we have provided a loan to our employee, then you have to understand employee is related with operating, isn't it? The salaries we pay, he's related with operating, isn't it? The employee. So the loan that we give to the employee, advance that is given to employee, the loan, that is also operating activity. You might think it is investing activity because we are lending the money. Normally, if we lend the money to any third party, for example, our subsidiaries, then that would become investing activity because we have given a loan and then we'll earn interest, right? So that's investing activity. But if we give loan to the people who are related with our operation, the employees, right? The debtors, the suppliers, then it would be related with operating activity. Is it clear? Because those people are related with operations. Fine. So that's the thing. So you understood this. Now all these examples which I gave you, these are for non-financial enterprise. For non-financial enterprise, normal company. There are companies which deals in financial products, right? Banks, NBFCs, right? Investment management company, hedge funds, all these are what? Financial enterprises. So for them, the examples are different. But this thing is same only. The meaning of operating activity, investing activity and financing activity will be same. But the examples are not this. Examples will be different. Okay. So let's understand about the financial enterprises. Okay. So see here, the first thing is you have to understand, if you see any question, then always assume in the question you have got non-financial enterprise, a normal company. But if they specifically mention it is a financial enterprise, then only you have to solve according to that. Okay. So now see here, I wanted to explain you this treatment of interest and dividends. Just now we saw that interest received is investing activity, interest paid is financing activity, dividend received is investing activity, and dividend paid is financing activity, isn't it? See here, interest received, dividend received, we are getting it because we have invested, so it's investing activity. Okay. And then interest paid and dividend paid is financing activity because we have raised the finance. So we are paying the interest, we are paying the dividend. Is that clear? These are for non-financial enterprise. Yeah, that's what I have written over here. Interest receive, investing, dividend receive, investing, interest paid, dividend paid, financing, financing. Clear? But when it comes to financial enterprise, whose main business is just taking the loan, giving the loan, buying the shares, selling the shares, right? Like investment management company, banks, NBFCs, etc. For them, interest received means it's a normal thing. Okay, it's a normal thing. So that would be operating activity. It's related with their operation only. That's the main item in which they deal in the financial products, the financial assets, right? So interest paid, operating activity, dividend received, operating activity. Okay, just the dividend paid will be financing for financial enterprise also. Okay, dividend paid will be same only because these companies will also issue equity shares and they will raise finance. So on that finance, they are paying dividend. That's financing activity only. Is that clear? Okay, there is no change in that. This can't be operating. This will be financing only. Just remember that dividend paid will always be financing. But interest received, interest paid, dividend received, these three things can become operating if we have a financial enterprise. Is it clear? Simple. So see here, unless otherwise stated in the question, always assume in the question you have got non-financial enterprise. Is it clear? Now see here, let me just show you some more cash flows about the financial enterprise. See, for financial enterprise, the following cash flows, for example, let's just say bank. Okay, the following cash flows will be part of operating activities. What cash flows? Loan that is given to the customer. Yeah, the loan advanced to the customer will be a operating activity, because for bank it is their operation. That's the main product in which they deal in, isn't it? Giving the loan and then getting the loan back, earning the interest. So loan repaid by customer, that's also an operating activity. Fine. And then the deposit which they accept and they repay, that's also an operating activity. So because of this, cash flow is happening, right? So in cash flow, these transactions has to be classified under operating activity. Is that clear? And interest paid and received, as I said over there only, yeah, interest paid and interest received will be operating only. Clear? And dividend received will be also operating, but dividend paid will be financing. Is it clear? You understood this? Simple, right? Treatment of interest and dividend. So you have understood right now how we have to classify the cash flows. Yeah. Now let's just see the methods of preparing cash flow statement. Now see here, we have methods of preparing cash flow statement. It's really simple. We have two methods, direct method and indirect method, and believe me, both of them are same only. It's just that in indirect method only small difference is there. That is, cash flow from operating activities will be computed in a different way. That's all. Rest everything is same only. The entire format is same. Just operating activity, it can be calculated by way of direct method or by way of indirect method. Is that clear? Rest investing activity and financing activity will be calculated with the direct method only. Here also, here also. Is that clear? So the entire format and everything is same. It's just the format differs in case of operating activity. Is that clear? So that is why what we are going to do is we are going to just focus on the direct method first, and then we'll move on to the indirect method. Okay, so see, what is direct method? Direct method is really simple. It's also known as pick and drop method. Why pick and drop? See, in the question they will give you gross receipts and gross payments, basically a summary of cash account. In cash account, what will be there? There will be lots and lots of individual chronological transaction, right? So from that we can't make cash flow statement. It will be very difficult. So the question will give you gross receipt and gross payment, how much tax we have paid, how much rent we have paid, how much operating expenses we have paid, right? And then they will tell you how much cash we have received from our debtors, how much cash we have paid to our suppliers. All these information will be given to you. You have to just look into that summary and identify where those gross receipts and payments will go. Will it go in operating? Will it go in investing? Will it go in financing? Right? Rent paid, it will go in operating. Rent received, it will go in investing. Okay, like that. You have to just classify and over. Okay, and then at last what you will do, you will add up all the cash flows from these activities. You will get net increase or decrease, and then you will take what opening balance of cash and cash equivalents, and then closing balance of cash and cash equivalents. Don't worry, we'll see the format, you will understand. It's really simple. Okay, nothing is there in direct method. The problem comes in indirect method only because operating activities will be calculated in a different way, but that also we will solve by studying very basics and everything, right? Okay, so now see here, let me just show you the steps involved in the preparation of cash flow statement. See, first what we need to do is we need to calculate the cash flow from operating activities, right? This figure can be positive as well as negative. Okay, if it is positive, that means we have received this much money from operating activities. If it is negative, that means that much money has been used because of operating activities. Okay, and this figure, this first figure, for this only there is the method, direct method or indirect method. Rest these steps are same. Whether the question tell you solve through direct method or indirect method, step 2, 3, 4, 5, 6 will remain same only. There is no difference. The direct method or indirect method only for the calculation of cash flow from operating activities. Is it clear? Is that clear to you? Simple. Okay. So the same way in the step 2 you will calculate the cash flow from investing activities, but here only direct method, pick and drop. That's all. For financing activities also the same way, pick and drop, okay, cash flow from financing activities. And here also the answers can be negative as well as positive, these figures. Positive means we have generated cash, okay, we have earned cash, we have received cash. And if it is negative means the cash has been utilized. Is that clear? That much cash has been utilized. Is that clear? So these are net cash flows, okay, net cash flow from financing activity. And then you will add all these three up. For example, let's just say 100, 100, 100, okay, positive. So that's equal to 300. What is this? Step 4, calculate the net increase or decrease in cash and cash equivalents. I told you from operating we have got 100 rupees, from investing we have got 100 rupees, from financing we have got 100 rupees. So in total in this current year what you have got? You have got 300 rupees. That's the interpretation, simple interpretation. 300 increase has happened because of the cash flows. Okay, 300 rupees you have received. If this is negative, then it's called decrease. This much money we have lost in the current year. In net this much money we have utilized. Okay, that's what it means. So let's just say 300 positive is there over here. Then what you will take over here, calculate the cash and cash equivalent at the beginning of the period. It will be given to you in the question. You will take it. Let's just say you had 500 cash in the beginning of the year, on the first day of the year. So 300 you have earned in the current year, 500 you had from the beginning, right? So the closing balance will be how much? 300 plus 500, the closing balance will be 800. Is that clear? 300 you have received in net, I'm talking about, and 500 you had from the beginning, so 800 you have at last. And this 800 will be mostly given in the question, the closing balance of cash and cash equivalents. So you will be able to verify your answer, whether at last your figure is coming right or wrong. Okay, and then you can also do some adjustment. If let's just say the answer is not matching up, then you will come to know you have made a mistake, and you will see, you will check again, and you will come to know, okay, this was not supposed to go like this and all, and you will be able to, modify your answer. Is that clear? This is how it is. This is how you have to prepare the cash flow statement. It doesn't matter whether it's direct or indirect. That matters only for operating activities, only this figure calculation. Okay, is that clear? So this is the universal mini format of cash flow statement. Is that clear? Simple. Okay, 300, then you will add this, it will become this, step 4 plus step 5. Step 4 plus step 5, that's equal to step 6. Clear? Simple. Now let's see the actual format of the direct method. Now see here we have the actual format of cash flow statement under direct method. Okay, so what did I tell you? It's nothing but pick and drop method, right? So see here, first we'll start from operating activities. Okay, this is the order. Cash flow from operating activities. First, what you will take? Cash received from sale of goods. Really simple, it will be given to you in the question, just take it, right? Cash received from trade receivables. That means from debtors how much money you have received. So that will come over here. The first one is cash sales. The second one is of the credit sales, how much money you have received. And then the third one is cash received from sale of services. Okay, that's the same thing. I mean, sale of goods, sale of services, same thing. Clear? Okay. And then, you will subtract all the payments that you are making, payment for cash purchases. So whatever money that you have paid to purchase the goods on cash basis, that you will take. And then payment to trade payables. Let's just say you have purchased from your supplier on credit and now you're making the payment, then that's called payment to trade payables, right? And then payment for operating expenses. So whatever operating expenses you pay, such as rent paid, electricity paid, yeah, and then advertisement expenses, salaries paid, any employee benefit expenses, all these are what? Operating expenses, telephone bill. So all these are, operating expenses. Is that clear? In the bracket I have given certain examples over there. So understand, okay, in cash flow statement, what you will do, you have only two things over here. Either you have inflow or you have outflow. So just remember the golden rule. If it is inflow, you will add. If it is outflow, then you will subtract. Is that clear? That's what you have to do simply. So see here, inflow I have added and outflow I have to subtract. Okay, so I'm taking first in the inner column and then I will add it up and take it in outer column as a negative and subtract from the above figure. Is it clear? Simple. Okay. Then see payment for wages and salaries, income tax paid. I've told you income tax is what? Income tax is an operating activity, right? and any refund also you got, that's also an operating activity. So what are we going to do is, in the format, when we take the income tax, let's just say for example, income tax paid is, let's just say 100,000, 1 lakh, okay, 1 lakh. But let's just say we have got refund of 10,000. So how much you will take over here? Will you take 1 lakh? No, you will take 90,000. 1 lakh minus refund. 1 lakh minus refund 10,000, that's equal to 90,000. 90,000 figure you will take, because that's the net income tax you have paid. Okay, you will take a net figure. Is it clear? Let's just say for example, 10,000 tax you have paid and 2,000 rupees you have got refund. So you will take 8,000 over here. Is it clear? Simple. Income tax paid is a cash flow from operating activity. Fine. So let's just say the above figure is, let's just say 50,000 over here, and all these less is equal to 30,000. So 50,000 minus 30,000, that's equal to 20,000. That would be called as, you know, net cash from operating activities. Is it clear? But if there are any extraordinary items, let's just say for example, you have received insurance claim from, you know, insurance company on account of loss of goods by fire. Loss of goods by fire or stock by fire, then that's an extraordinary item which is related with operating activity. Goods are operating activity, isn't it? Yeah. And then any proceed, let's just say you have received from earthquake disaster settlement, that's also related with operating activity. So you will, you know, add or subtract based on what it is. If it is, let's just say receipt, then you will add. If it is payment, then you will subtract. I told you, the golden rule is, if it is inflow, you have to add. If it is outflow, then you have to subtract. Is it clear? This is how you have to do it. Okay, 1,000, let's just say proceeds you have received from earthquake disaster settlement. So you will add 20,000 plus 1, that's equal to 21,000 net cash from operating activities. You have got a positive figure. That means because of operation, our company in net has received this much cash, 21,000. Is it clear? If it was negative, then we say net cash used in operating activity. Is it clear? This is how you have to write it. Fine. Okay. Now after this, operating activities is over. Now we'll move on to the cash flow from investing activity. Now cash flow from investing activity, what will come over here? We have already discussed purchase and sale of fixed assets, right? Purchase of fixed asset, and then if you are selling the fixed asset, then sale value you will take. Remember that. You have to take whatever that is affecting the cash. How much cash we received, how much cash we paid, that's what matters. Okay, you will not take cost of fixed asset. You have to take cost plus the profit which you have earned, or you have to, if you have incurred a loss, then you have to subtract the loss. So that is how you have to take. You have to take the sale value. And then see purchase of long-term investment, yeah, sale of long-term investment, interest which you have received, dividend which you have received. All this is investing activity, isn't it? You are getting interest, you are getting dividend because you invested. You are getting rental income because you purchased a flat or a building like that. Is it clear? That's how it is. Fine. And then you will add up all of this. Okay. And here, see, purchase is there. Purchases will be negative. So that you will have to subtract. Is it clear? Inflow will be added, outflow will be subtracted. As simple as that. And then see, the figure will come over here. Net cash from or used. If it is positive, that means we have generated. You can also say net cash generated or net cash from investing activities. If it is negative, net cash used in investing activities. Is it clear? Right. And then after this, you have to do the financing activities. See here, cash flow from financing activities. You have to write the heading and you have to go on taking whatever cash flows you have related with financing activities. Proceeds from issuance of share capital. Yeah, you are issuing the shares, you will be receiving the money. So that's a plus. Proceeds from long-term borrowings. You have issued debentures. So you will plus over here. Repayment of long-term borrowing. Let's just say you have redeemed some debentures which are maturing this year. So that will be, subtracted over here. Let's just say you have repaid some loan this year. Then that will also be subtracted over here because that's an outflow. Redemption of preference shares, outflow. So that will be subtracted over here. If you have issued preference shares, that will be added. Buyback of shares, again outflow, it will be subtracted. Interest paid, outflow, you have to subtract. Dividend paid, outflow, you have to subtract. Is that clear? That's how you have to do. It's really simple. It's not difficult. Fine. And then you will add up all of that. That will become net cash from or used in financing activities. If it's positive, then it's from. If it is negative, that means that much money has been utilized in net by financing activities. Is it clear? That's the interpretation. And then finally what you will do, finally see here, you will add up this net cash from operating activities, net cash flow from investing activities, and net cash flow from financing activities. A, okay, see here, A plus B plus C. All these three figures, net cash, you have to add and you have to take it over here. Let's just say, for example, 10,000, 10,000, 10,000 are there. Okay, so net increase will come in cash and cash equivalents, 30,000. I explained in the mini format here, the same thing is happening. That same thing you have to do. Okay, net increase. If it is negative, then we call it as net decrease in cash and cash equivalent. In the current year, this much increase or decrease happened. And then you will take the opening balance of cash and cash equivalent, which will be given to you, or maybe you might have to calculate that. Okay, if it's not given, it can happen, but it will be very simple. Don't worry. When we'll solve the problem, you will understand all that. Okay, and then cash and cash equivalent at the end of the period you have to take. In the current year, I just told you 30,000, increase has happened. Let's just say in the beginning there was 10,000 cash balance. So 30 plus 10, that's equal to 40,000. So closing balance will be 40,000. And if you'll see in the balance sheet which is given to you, or the information that is given to you, there you will find the ending balance mostly will be given to you. So you can confirm and verify your answer. Okay, but still you can make mistake, okay, even if you verify this, because you might just shuffle the things from one activity to another activity, and overall the net effect will be same only. So that can also happen. So you have to be careful while preparing the cash flow statement. Don't worry, when you'll practice lots of sum, you will get better. First you need the concept clarity, understanding, and the silly basics. Okay, that's why people mess up in this cash flow statement, because they mess up the basics. Okay, so do you understand this direct method format? If you have any doubts in this format, please ask. Just take a screenshot and message me in Instagram. Okay, so this is the direct method. Okay, operating activities, investing activities, and then here you have financing activities. And here what you do, you take net increase decrease, opening balance of cash and closing balance of cash. That's all. That's what a cash flow statement is. Now in indirect method, what will happen? In indirect method, let me tell you, this will remain the same format. This is also same format, no change at all. This also same format, no change at all. The only change will be this. Okay, operating activity will be computed in a different way. From profit, we will go to cash flow from operating activities. Okay, backward calculation will happen in case of indirect method. Indirectly, we will go to the cash flow from operating activities. So let's understand now the indirect method. Now see here, we have our second method of preparing cash flow statement. It's really simple, believe me, it's not difficult. It seems complicated because it is little bit lengthy and we are calculating from a different way. Okay, but don't worry, we'll go slow, we'll understand bit by bit everything, and believe me, at the end of this video you will feel how simple this method is. Okay, so how and what will happen in this indirect method? See, in this indirect method, we are going to calculate cash flow from operating activities in a different way. That's all. Rest, investing activities and financing activities, the same way, pick and drop method, direct method only. Okay, so if I show you the mini format, which I have shown you earlier, I've told you in the indirect method, only this first step, this figure will be calculated by way of indirect method, a different way. Rest everything, step 2, 3, 4, 5, 6 remain the same way you have to do as what we have seen in the direct method. Is that clear? Pick and drop for the investing and financing activities, and then here net increase or decrease, opening balance, closing balance. Is that clear? No difference at all. If you see the detailed format of direct method, see, investing activities, the same format, financing activities, the same format, this also same, just operating activities will be done differently. Is that clear? So now let's understand how we are going to calculate the cash flow from operating activities in a different way. See here, we are going to start from the profit figure. From profit, we are going to reach to cash flow from operating activities. But how that will happen, that's the entire game, and that's what I'm going to teach you. what are the steps that you need to follow so that your profit will get converted into cash flow from operating activities. You just have to add something and you have to subtract something. Okay, so now understand, in the question what will happen is you'll not just have a single profit. Okay, in different questions different sort of profit will be given to you. What does that mean, different sort of profit? It means there are three different types of profit. There is net profit before tax, there is net profit after tax, there is profit after all the adjustment and appropriation, okay, which is called as retained profit or the reserves and surplus figure, right? That's what it is. Fine. So you see over here, profit can be of three types: net profit before tax, net profit after tax, or retained earnings. Any one of these will be given to you in the question. You have to understand, if net profit before tax is given, then your work becomes easier. Yeah, your solution becomes easier. So first priority we give it to net profit before tax. But if that's not available in the question, you have to look for net profit after tax, whether that's available. If it's available, then good. If it's not available, then lastly there must be retained earnings given in the question. Okay, they might say profit after all adjustment. You have to understand they are talking about retained earnings. Okay, or maybe they will not say that also. They will just give you the balance sheet and opening balance of P&L and closing balance of P&L. So what you're going to do, you are going to calculate the retained earnings simply by taking closing balance minus opening balance. Okay, closing balance minus opening balance, and you will get how much profit you have earned in the current year after all adjustment and appropriation. Okay, that's what you will get, retained earnings. Is it clear? Fine, this will be the formula you will be applying. It's really simple. When we'll solve the question, you will understand and you will see how we do that, right? Okay, so that is what is indirect method. From profit we are going to go to cash flow from operating activities. Fine. And for investing and financing activities, as I said, the same direct method is there, nothing different. Okay, the same way you have to do it as we have seen the direct method format, right? So this is what is indirect method. Now you have to understand, see how we have calculated this profit. Yeah, from where do we get this profit? We get this from statement of profit and loss or profit and loss account, isn't it? Yes. So you have to understand, in statement of profit and loss, it's prepared on accrual basis. Statement of profit and loss is prepared on accrual basis. That means it includes cash items as well as non-cash items. For example, depreciation is a non-cash item. Yeah, it is debited to statement of profit and loss. What does that mean, debited to statement of profit and loss? It means, debited means subtracted in profit and loss. Okay, it's an expense, right? Depreciation, it is subtracted in statement of profit and loss to calculate profit or loss. Yes, debited means subtracted, credited means added in the language of statement of profit and loss. Is it clear? Okay. And cash items are also included in statement of profit and loss. For example, the rent you have received, it's a cash item. Interest you have received, it's a cash item, right? For example, let's just say rent you have paid, it's a cash item. Dividend you have received, it's a cash item. Do you understand this? All these items have gone in statement of profit and loss, cash item as well as non-cash item. Whereas in cash flow statement, what do? I've told you, in cash flow statement, only those items will go which causes the cash flow, right? I have given you the golden tip. Whatever that goes in the cash or bank account also goes in the cash flow statement. Cash flow statement is prepared on the cash basis. The entire game is on the cash. Okay, so here depreciation will not go, right? Depreciation will not go in cash flow statement. Bonus issue will not go over here. Why not? Because it is not causing any cash flow. There is no inflow or outflow because of bonus issue, because of depreciation. For example, preliminary expenses written off. All these are non-cash items. Do you understand this? This is the difference. So if you want to go from profit to cash flow from operating activities, then what you have to do? Just think, just visualize, just think what you have to do. Whatever non-cash items are there, those non-cash items should be eliminated so that we can reach to cash flow from operating activities. Do you understand this? Okay, is it clear? Yes, we have to change from accrual basis to cash basis. So we have to make those changes. Whatever non-cash items are there, we have to eliminate that. We have to reverse that. But let me ask you how you will reverse. It's really simple. To reverse, what you have to do, first you have to see whether it is debited or credited in profit and loss account, in statement of profit and loss. Debited means subtracted, credited means added. This is what has happened previously. In cash flow statement, you want to reverse. So you will just do opposite. Whatever that is subtracted, you will add. Whatever that is, added, credited, you will subtract. Is that clear? Just a reversal you will have to do of non-cash items. Fine. Okay. Then one more thing. Understand, in profit and loss statement, everything has gone. Do you understand this? In profit and loss statement, to calculate the profit or loss for the year, what have we done? Profit or loss is of the whole company. So all the items have gone into that. By all the items, I mean items relating with operation, items relating with investing, items relating with financing. All the items have gone in the income statement. See, interest received, dividend received is related with what? It is related with investing activities. But when we prepared income statement, when we prepared statement of profit and loss, we took the interest received, dividend received, rent received, all in the statement of profit and loss, right? But that is not of operating activity, that is of investing activity. While preparing investing activity, we will do pick and drop, and we will take interest received, dividend received directly here, okay, cash flow from investing activity in that format. But in this conversion, what we need to do, already interest received, dividend received is there over here. So what we have to do, we have to reverse that also. Understand, interest received, dividend received, rent received, these are indirect incomes and of non-operating. These are of investing family, outsiders. Our family is this only. This is the operating family, right? So outsiders are there. These are the outsiders which are sitting in the income statement. We have to convert that. So we will eliminate these outsiders. We are going to kick these outsiders. Yeah. Who are these? Interest received, dividend received, rent received, right? So we are going to eliminate them. We are going to reverse them. How are we going to do that? Tell me, how are we going to do that? Simple. These are incomes which were credited in statement of profit and loss. Yeah, they were added. These are incomes. So if you want to eliminate, I've told you, whatever is credited in income statement in profit and loss, that means it was added. To reverse, you have to subtract in cash flow. Is that clear? That is what you will have to do. So I explained you just now two things. The first is I explained you reversal of non-cash. Whatever that is non-cash, reverse that. Whatever that is, of non-operating, you have to eliminate that. They are not of our family. They are not of operating family. They are of investing family, maybe financing family. So we have to just kick them out from the profit figure. That's what we have to do. Then only we will be able to reach to cash flow from operating activities. Is it clear? Okay. So see here, let me just show you more differences between statement of profit and loss and cash flow statement. See, in statement of profit and loss, see, only revenue nature items will come, income and expenses, that's all. In statement of profit and loss, what do we take? We take only revenue nature items, the incomes of the current year and the expenses of the current year, isn't it? Yes, but in the cash flow statement, it's not like that. We don't just take income and expenses. We take everything, all the elements of financial statements. We take asset, liability, equity, income and expense, whatever that impacts the cash, isn't it? We just don't take, advertising paid or rent paid or salary paid. No, if we have issued equity shares and we are receiving money, that also goes over here. That's an equity, right? That also goes in cash flow statement. If we have redeemed any liability, that also comes over here, right? Everything comes over here in cash flow statement. Whatever that impacts the cash, that will come in cash flow statement. Is it clear? Okay. And statement of profit and loss, what is the objective over here? The objective is statement of profit and loss shows us the financial performance of the company, yeah, for the period, yeah, for the year. how much profit or loss we have made, whereas the cash flow statement shows us the liquidity position, how much cash does the company has, and how the cash has moved, the movement of cash over the period. That also we get to know from the cash flow statement. Okay, that's the objective. Fine. And another one small difference I want to explain you. Understand, most of the students get confused in this, right? See, understand, in statement of profit and loss, when we see tax over there, tax expense, what is that tax expense? That tax expense is current year provision that we have made for tax. Okay, it's a provision, it's a non-cash thing. Because of that, there is no cash flow. It's just a book entry, just a provision that we have made, we have provided for tax. Whereas in cash flow statement, this is reversed. This doesn't matter to us. In cash flow statement, we don't take this. Yeah, let me just show you the direct method. In direct method, what did we do? In direct method, see, we just subtracted income tax paid by taking net of refund. Yeah, this is tax paid. That is what we take in cash flow statement. We don't take income tax provision. Income tax provision, yeah, this provision for tax is what? This is non-cash item. Okay, we are not paying anything in this. This is just a book entry. So we reverse this. Okay, this is an expense in statement of profit and loss. So it has been subtracted, it has been debited. So how we are going to reverse? Tell me. Something is debited, which means subtracted. How we are going to reverse? To reverse, we have to add back. Do you understand? I'm going to keep using this term, reverse, reverse, eliminate, reverse, eliminate. You have to understand now what I'm talking about. Whatever that has happened in statement of profit and loss, reverse means just do opposite, so that the effect will be nullified. Is that clear? Right, understood. Now, in cash flow statement, we take tax that is paid. It can also be advanced tax, which we'll learn in a separate video, the advanced tax process and everything. Right now, just simple adjustment we are going to consider. Okay, tax paid. So tax paid means how much tax we have paid. Yeah, the cash is actually paid to the government. So that's what we are going to consider in cash flow statement. Okay, you understood the difference between statement of profit and loss and cash flow statement, right? And I told you how we are going to go from profit to cash flow from operating activities. Two things I told you. The first, eliminate non-cash, reverse non-cash. Okay. The second thing I told you, that whatever outsiders are there, outsiders means the items which are of different family, of investing family, financing family. You all know they can't be in our family, on our table. So we have to just kick them out. We have to eliminate non-operating items. Is that clear? Do you understand this? Easy. Now let me just show you the format of statement of profit and loss so that you can understand how it all happens. See here. This is not the exact format as per the Companies Act, but you can understand here. See, first what happens? First we take revenue, we subtract direct expenses, like trading account happens first, right? And then we get gross profit, isn't it? Yes. So from gross profit, what do? We add all indirect incomes and we subtract all indirect expenses. We get net profit before tax, right? So what is included in indirect income and indirect expenses? Do you know? Yes, you know. Indirect expenses means depreciation, rent paid, electricity paid, stationery paid, right? All these items will come, marketing expenses, right? Interest that we have paid, all these are indirect expenses. Fine. And indirect income means that rent we have received, right? And then any indirect income, for example, let's just say we invested in any company, we got interest, interest received, dividend received, all those are indirect incomes. So you understand, statement of profit and loss has been prepared for the whole organization. In this, what do you have? You have all the items. You have operating items, you have investing items, you have financing items, everything has gone into this, right? So from this, we have to go to where? We have to go to cash flow from operating activities, right? So here, what is sitting? Investing items and financing items are sitting over here. So that you have to reverse. We call them as outsiders. Okay, non-operating. Is that clear? So those outsiders, we have to kick them out, because here we just need operating family, our family. So whoever are there from outsider, just kick them out. You have to reverse that. Fine. And then here there are also non-cash, such as depreciation, I told you, right? Such as, for example, preliminary expenses written off. So all that also we have to kick them off. Is that clear? Right? So non-cash we have to remove, and outsiders also we have to kick out, right? Okay, then see what happens in statement of profit and loss is, yeah, after getting net profit before tax, we subtract the tax provision, not the tax paid. In statement of profit and loss, we always take the tax provision. This is a basic, silly basic that everyone needs to know, and most of the students don't know this, right? Here we don't take tax paid, here we take tax provision. Okay, how much provision we have created in the current year. Is it clear? Simple, understood. After subtracting that, we get net profit after tax. Okay, and then we do the appropriation. What appropriation? What do you mean by that? Appropriation means distribution. Okay, any preference dividend we have paid, it will be subtracted. Any dividend, final dividend we have declared, then it will be subtracted. Any interim dividend we have paid, yeah, the dividend that is given between 2 AGM, which is declared and paid in the current year, that will also be subtracted over here. And any transfer to reserves if we have made, for example, we have transferred to CRR, we have transferred to general reserve, or we have transferred to any other reserve, that will also be subtracted over here. Okay, and then let's just say, for example, we have redeemed debentures and preference shares at a premium, then we have to pay that extra amount, right? So that extra amount is a loss for the company, you all know, and that loss is called as premium on redemption of debenture or preference shares, isn't it? So that also needs to be written off. So when it's written off, we write that off through P&L. If it has been written off through P&L, that means it will be, you know, coming over here. It's an appropriation, it will be deducted over here. So then we will get what? The profit that is left after all the adjustment. Yeah, in the final accounts, after all the appropriations, we get this figure, which is called as retained earnings. Then what happens of this figure? Do you know? This figure goes in balance sheet. This figure goes in balance sheet. In balance sheet already you will have retained earnings, which is the accumulated profit from the past 5 years, 6 years and all. Okay, that balance will be there. To that balance you add this current year balance after all adjustment. That is what you do. Okay, do you understand this? This is what happens in final accounts. Yeah, when you prepare financial statements, you need this basic, then only you can understand cash flow statement, right? Is this clear to you, the basics of statement of profit and loss and the profit thing? Okay, now I told you what we need to do in indirect method. From profit we have to go to cash flow from operating activities, right? And I told you two things. First, we have to reverse non-cash. The second thing I told you, we have to reverse non-operating. Whatever that is of different family, we have to kick them out. Okay, whatever that is related with investing, kick them out. Whatever that is related with financing, kick them out. Is that clear? Okay, that's what you have to do. So to do this, we have, you know, 3 starting points. In indirect method, we have 3 different profits, 3 different starting points. Okay, see, we have net profit before tax, net profit after tax, or retained earnings. The first priority we give to net profit before tax. If you have net profit before tax, then you can start from over here in the indirect method format. Okay, in the cash flow. If you start from over here, just think, if you start from over here, do you have to reverse these things? Do you have to reverse tax provision? Do you have to reverse the appropriation? No, you don't have to reverse that. You are standing over here, net profit before tax, just reverse what? Just reverse these things. Okay, whatever that is of not operating, yeah, non-operating and non-cash, which are included over here in the P&L account, yeah, only reverse that. That much is enough. Okay, that much is enough. Is that clear? Yeah. But let's just say, for example, if this is not given in the question you have net profit after tax and after extraordinary item, or maybe just after tax, then what you will do? If that is the case, then you are starting from over here. This is your starting point. So you will have to reverse the tax provision. Tax provision is an expense. It has been what? It has been debited in profit and loss. Yeah, it has been deducted. You will have to reverse. By reversing, we mean we have to do opposite. We will have to add, isn't it? So we'll have to reverse the tax provision. And then we have to reverse this also. In this indirect incomes and expenses, whatever that is of non-cash and non-operating, we have to reverse that. Do you understand the logic? Okay, how we have to go? Are you getting the proper overview right now? Yeah. So see here, if this is also not available, let's just say the second priority which we give to net profit after tax, this is also not available in the question, then what you will do? Then you will have no option left. You will have to start from the last thing, that is the retained earnings. but this can also be not given in the question directly. Sometimes they will say profit after all adjustment, then you can understand, okay, retained earnings is given. But if they are not saying something like this, they have just given you the balance sheet, then you know, if just balance sheet is given, what I will do, I will go in reserves and surplus, I will find profit and loss balance, right? Two balances will be given of previous year and current year. So you will take the closing balance and opening balance, okay, and you will subtract closing balance minus opening balance. Closing balance means the current year balance which will be given over there, and opening balance means what? The previous year's closing balance will become opening balance of current year, okay? So that is what you have to do, 2022 minus 2021, like that, okay? For example, right now 2024 minus 2023, that's what you will do. Is it clear? Closing balance minus opening balance, you will get the retained earnings of the current year after all the adjustment, after all the appropriation. You will get this figure. When you get this figure, what you need to do, you have to start reversing everything you have to reverse, okay? Sometimes students get confused, you know, they think, why are we adding back the tax sometimes, and sometimes we are not adding back the tax. Yeah, sometimes we are reversing the transfer to reserves and dividends, sometimes we are not reversing them. What's the issue over here? Yeah, they get confused like this. You have to understand, you need to know from where you are starting. If you are starting from retained earnings, you have to reverse everything. All the appropriation you have to reverse, the tax you have to reverse, provision as well as refund, both the things, okay? Because refund we are going to consider that at last. Is it clear? In operating only. So that is why provision and refund, both you have to reverse, okay? And then whatever non-cash and non-operating you have, that also you have to reverse. Is it clear? Do you understand this? Statement of profit and loss is prepared on accrual basis. It includes cash items as well as non-cash items. Yeah, it will be sitting over here. Tax provision is also non-cash, and here also you will have some non-cash items. So all that you have to reverse. If you start from over here, everything you have to reverse. If you start from second priority, yeah, net profit after tax, you don't need to reverse the appropriation, but you have to reverse provision and this. But if you start from the first priority, yeah, then you don't need to reverse tax, you don't need to reverse this, just reverse the non-cash and non-operating that is sitting over here. Is it clear? So the trick of indirect method is really simple. See, 3 steps of indirect method. First, you will do reverse of non-cash items, okay? Let me just show you non-cash items. See, non-cash items, for example, depreciation, amortization, provision for tax, foreign exchange loss, preliminary expenses written off, all these are non-cash items, right? In direct method, we just do not consider that. Yeah, in direct method, yeah, we just don't consider that. We just ignore them. But in indirect method, we must reverse them. We must reverse them. How do you reverse? If they have been previously taken to P&L, that means they are sitting over here, non-cash items. Yeah, they are not of our family. We have to kick them out, non-cash items. I mean, they are not the family of cash flow only, non-cash items. So in P&L, they must have been debited or they must have been credited. Either they have been, subtracted or added. So to reverse, what you will do, to reverse, you will, add if it is subtracted. You will subtract if it is added previously. That's how you reverse. So I will keep on saying this, okay? Reverse, eliminate. You have to understand what I'm talking about. Whatever that has happened, reverse means doing opposite of that. Is it clear? Fine. So we will reverse non-cash. But there is one small thing, okay? Do not reverse non-cash items which are of operating nature, okay? Bad debts, discount allowed, discount received, or stock valuation, all these are non-cash items, okay? But we will not reverse them because reversing is waste of time, because if we reverse or not, the end effect is same only. That's why we'll just ignore them. But if you get an MCQ or any question where they ask treatment of bad debts, then you have to say that, it will be reversed. It's a non-cash item. Fine. But while solving the question, we'll just ignore them. Is that clear? Okay, those are non-cash items. So we have to reverse non-cash only of non-operating nature. Operating nature non-cash items we will not reverse. Okay, that's the first step of indirect method. Then the second step is what? Second step is get rid of outsiders. As I told you, here in indirect income and indirect expenses, what is sitting over here? People from other family. Interest received is of investing family. Dividend received, rent received is of investing family, which are sitting in indirect incomes. We have to reverse them. How you will reverse? It is added normally. So do opposite. You will subtract interest received, subtract dividend received, subtract rent received. Is that clear? Simple. Yeah, that's what get rid of outsiders. Yeah. And then in indirect expense, you can have interest paid. Dividend paid is an appropriation item. Interest paid can come over here, indirect expense. So what you are going to do? It is subtracted normally. You have to reverse that because it's of different family. It's of financing family. We can't keep it in operating, right? So we have to eliminate it. We have to reverse. Normally it is subtracted. What we're going to do? We're going to add it back. Interest paid. Is it clear? Get rid of outsiders. Send them to their own family. What does this mean? Send them to their own family. It means when you will prepare investing activity and financing activity, they are always prepared according to the direct method. So just directly you are going to pick interest received, investing activity, dividend received, investing activity, like that. That's what it means. Send them to their own family. Okay. We'll consider those items in their own heads. Is it clear? Okay. And then we have something called as changes in working capital. Okay. See, what happens is there are certain items, okay, certain items which do not impact the profit and loss, okay, but they affect the cash flow. They don't come through profit and loss. For example, the cash that we receive from debtors, those items, right? So what we do is, we just consider changes in those items. Working capital means current asset minus current liabilities. So what we do is, whatever current assets and current liabilities we have of operating nature, we just see the change in that. For example, opening balance was 10,000, closing balance is 15,000 of current asset I'm talking about, okay, of debtors, receivables. So 5,000 increase has happened. So what do? We just subtract in the cash flow statement in indirect method. Why? What's the logic? We'll understand the logic, but right now just understand the shortcut. Asset and cash are negatively related. Whenever asset increases, cash decreases. Yeah, as I told you, 5,000 increase happened in current asset, we have to just subtract. Yeah, asset increase, cash decrease. If asset decrease, cash increases. Okay, and with liability and cash, they are positively related. When liability increases, cash increases. When liability decreases, cash decreases. For example, there is trade payables. Opening balance was 7,000, closing balance was 3,000. So decrease of 4,000 has happened. So what are you going to do? Liability decrease, cash also decrease. You're going to subtract that. Is that clear? That's how you have to do it. So these three things you have to do: reverse non-cash, get rid of outsiders, and changes in WC, working capital. Okay, we'll discuss each of these things, okay, working capital and all, don't worry. But right now let's just see the format, the detailed format of cash flow statement of indirect method, then you will understand better. Okay, now see here we have the detailed format of indirect method, and remember, indirect method is only for cash flow from operating activities. Rest everything is same only. Okay, right. So let's begin. First we start from where I've told you we have three starting points. So now to understand the format, we are starting from the third priority. Okay, and then I will explain you how we can reach over here and here. Okay, everything. So if we are starting from retained earnings, in the question, if they say profit after all adjustments, directly we can reach at this figure. You see this 3x, right? Directly over here. But if they don't say that, the question is silent, you have to look into the balance sheet. They will give you opening and closing balance of P&L, right? So what you have to do, closing balance of P&L minus opening balance of P&L. Okay, you will get the retained profit after all adjustments of the current year, right? Profit of the current year after all adjustments, right? Yeah. Then you have to reverse what, if you have this item, what you have to do next? Tell me. You will reverse all the appropriation, right? You will reverse all the appropriation. Interim dividend paid, any dividend that you have declared, any transfer that you have made to reserves, premium on redemption written off, all those items you are going to reverse. Okay, what does reversal means? Whatever that has happened previously in statement of profit and loss, you will just do opposite. Okay, that's what you will do. Is it clear? Okay, appropriation reversal, understood, sir. Moving on, then after doing this, where you will reach? You will reach at net profit after tax. After the reversal of appropriation, you have reached at the second priority, right? Then what you need to do? Tax provision. I've told you, you have to reverse the tax provision because it's a non-cash. There is no cash flow happened because of it. And refund of tax, even if cash flow has happened, that also you have to reverse. Okay, so see, add provision for tax. Provision for tax is normally subtracted. Previously it has been subtracted in statement of profit and loss, right? So now you will add. We are doing reverse, elimination. Is it clear? So we have to do opposite. Okay, add provision for tax. And if there is any refund, then we will subtract the refund, because normally what happens, refund is added in statement of profit and loss, isn't it? I mean, refund is added, so we are going to subtract refund of tax. Is it clear? Simple, understood. Then moving on, extraordinary items. Now what are extraordinary items? Understand, extraordinary items means something that is not ordinary in nature. Okay, that is completely different from what do you say, ordinary activities of business. For example, loss due to earthquake. For example, we have received insurance claim. Okay, maybe for example we have paid a penalty. Okay, we have lost a lawsuit, or maybe we have won a lawsuit and we have received the compensation. All these are extraordinary items which happen very rarely. They do not recur in nature. Okay, they are not recurring in nature. Is that clear? Those are extraordinary items. So what we have to do of that? We have to just simply reverse all extraordinary items. Whatever that were taken to P&L, all those we have to reverse. Is that clear? Previously, whatever that has gone in the statement of profit and loss, okay, all that we have to reverse. Is it clear? Yes, understood. Then what we have to do? Then we will reach at net profit before tax and before extraordinary items. Okay, over here, NPBT, we have reached over here. Okay, if you have seen other lectures, then you might have seen they already start their indirect method from over here, right? And they do this thing as a working note, but we are not going to do that. We are going to do everything all together. Is that clear? So right now we have reached over here, net profit before tax. Is it clear? Net profit before tax and extraordinary items. Now what we have to do? Tell me. We have to do what? We have to reverse non-cash like depreciation, preliminary expenses written off, amortization. Yeah, we have to reverse non-cash items. Fine. So see here, reverse non-cash and non-operating items. Non-cash and non-operating: depreciation, amortization, discount on issue of debenture, gain on sale of land, loss on sale of machinery, and foreign exchange loss. All these are what? Non-cash and non-operating. Is it clear? Okay. So all this you will reverse. Whatever that was added, you will subtract. Whatever that was subtracted, you will add. You know, right? How you will do the reversal? See, this is how you have to do the reversal. Whatever that is debited in P&L, which means subtracted, you will add that. Whatever that is credited in P&L, that means whatever that was added, you will subtract. Okay, that's how you will reverse. Is it clear? Reversal of non-cash. Is it difficult? Indirect method? No, it's not difficult. You just have to understand the basics. Okay, once you get the whole overview and we'll simplify it, it will be really simple for you. Don't worry. Okay, so when we'll reverse the non-cash, then what do we have? We have to get rid of outsiders, non-operating items. Non-operating items which are going to go into the different family. Okay, see here. Reverse items to be considered in other heads. So what are the items that are going to be considered in other heads? For example, interest received, dividend received, rent received. These are of investing family, but they have been taken to statement of profit and loss previously as an indirect income, right? So we'll have to reverse, we'll have to subtract all of that. Why subtract? Because they were added previously. Now we have to subtract. Or I can say they were credited previously in statement of profit and loss. Now I have to subtract, I have to reverse. Okay, so see, interest received, yeah, interest income, interest paid, dividend income, all this you will have to reverse. And when you will prepare the cash flow from investing and financing, at that time you have to take interest income will be investing activity, dividend income will be investing activity, rent income will be investing activity, and then interest expense will be financing activity. Okay, that's what I said now. Get rid of outsiders, kick the outsiders and send them to their own family. When we will prepare cash flow from investing and financing, at that time we will consider that over there. Is it clear? Understood. Moving on, then what we're going to get after doing that, we are going to get to operating profit before working capital changes. Yeah, we are this close to get to the cash flow from operating activities. We have to consider now working capital changes. Yeah, I've told you there are some items which do not impact profit, but they affect the cash flow, or vice versa can also happen, right? So we have a trick over here. Asset is negatively related to cash and liabilities are positively related to cash. Okay, so for current asset and current liabilities, we see the changes. Opening balance and closing balance we compare and we see whether it has increased or decreased. If current assets have been increased, we subtract. If current assets have been decreased, we add. If current liabilities have been increased, we add. If current liabilities have been decreased, we subtract. That's what we do. Okay. So see here in the format how we have to present it. Effect for changes in working capital. Increase in current asset, decrease in current asset. Increase in current asset will be subtracted, decrease in current asset will be added. As I said, assets are negatively related with cash, inversely proportional also you can say. And then current liabilities are positively related with cash or directly proportional with cash. If current liabilities increases, cash also increases. You have to add. If current liabilities decreases, cash also decreases. So you have to subtract. That's how you have to do it. This is a trick. This is a trick. The actual logic we'll discuss later. Okay, fine. So that's the thing. And then after doing that, what you will get cash generated from operations. Okay, cash generated from operations, and then you will subtract the tax paid the same way how you did in direct method. In direct method, what did you do in operating activity? See, at last you subtracted tax paid net of refund. Yeah, the same way you will have to do over here. Last, you will have to subtract the tax paid. So you have to understand, you reverse the provision, that's non-cash item, but at last you consider the tax, that is the actual tax paid. These two things are different. I told you now, in statement of profit and loss, we have current year provision for tax. This we reverse. In cash flow statement, this is not considered. This is just reversed. In cash flow statement, we consider the tax paid. What does that mean? We consider the tax paid. It means we subtract the tax paid. Okay. But now we'll take net of refund. For example, let's just say tax paid is 10,000 and we have got refund of 2,000. So we will take over here 8,000. 10 minus 2, that's 8,000. For example, let's just say 1 lakh tax we have paid, 5,000 refund we have got. So 95,000 you are going to take. Is it clear? And understand, first you have to reverse the tax, because understand, I mean refund of tax also you have to reverse. Why? Because we have to reach at net profit before tax and extraordinary item now. That is why we have to reverse. And then separately at last we'll have to show the tax paid and then the refund as a net. Clear? Okay, understood. Then we'll get cash flow before extraordinary items. You remember extraordinary items also above we have reversed, but now there is a difference. You know, most of the teachers don't teach this. See, understand, in the beginning we reverse all extraordinary items that has impacted the profit and loss statement, right? That has gone into profit and loss statement. Then at the below, what do? At the below you have to understand, here we add or subtract the extraordinary items which are relating to operating activities and which have caused a cash flow, For example, loss due to earthquake. Okay, that's an extraordinary item. Maybe it has been taken to P&L, so you reverse that above. And let's just say you have also received an insurance claim because of that. Okay, proceeds from earthquake disaster settlement. Okay, so here you will reverse both the things. Okay, reverse, you know, the loss due to earthquake and then the insurance claim received also. Okay, but here what you will have to do, you will consider only proceeds from earthquake disaster settlement, because in cash flow you can only have cash flows. You can't have just loss and all. Is that clear? Non-cash items cannot exist in cash flow. In cash flow, the entire game is on cash flow. Is it clear? In cash flow statement, the entire game is on cash flow. Fine. Okay. Now another example. Let's just say, for example, you have received insurance claim. There was a fire in your godown or in your office or somewhere. So your stock was destroyed. Okay. For that you have received insurance claim, and your non-current fixed asset PPE was also destroyed. For that also you have received insurance claim. So just tell me, both of these things will be reversed. No doubt will be reversed over here because the effect has gone in P&L. So you will reverse both of the things over here at the top. But in the below, at the below, see, insurance claim which you have received on account of stock is an operating extraordinary item. It's of operating nature. That you will add over here. You have received money, right, from insurance company in relating to the stock that was destroyed by fire. But the money which you have received on account of damaged PPE, your fixed asset which was destroyed, that money you can't take over here. That money you will take in the investing activity. When you will prepare the format of investing activity, the format is same only now. At last you have to add over here. Insurance claim received on account of loss of PPE by fire, damage of PPE by fire. you have to add over here. Is that clear? Because extraordinary item that is related with this activity. This is very important. You have to understand these minute simple things. Okay. And only receipt and payment are considered in cash flow statement, right? Loss due to just earthquake, that will not come over here. Is that clear? That will be just reversed and that's it. Fine. Proceeds from earthquake disaster settlement, we are getting money. So that will come. Clear? Understood. Extraordinary item thing is finished. We have understood that. Okay. Moving on. Net cash from or used in operating activities. Everything is over, right? This is the entire format of indirect method. Hope you have understood this. It was difficult? No, it's not difficult at all. It's really simple. What did we do? First, we started with the retained earning figure, right? We didn't have it. We went in balance sheet, closing balance minus opening balance of P&L. We got that. Then we reversed all the appropriation, all this thing, right? Then we reverse provision for tax and refund of tax, right? We reached at net profit before tax after reversing extraordinary items as well. Yeah, we reached over here NPBT, net profit before tax and before extraordinary items. Then we did what? We reversed non-cash of non-operating nature, non-cash of non-operating nature, and then we get rid of outsiders as well. Yeah, we got rid of outsiders as well. See, reverse non-cash and non-operating items like depreciation, amortization, discount on issue of debenture and all. And then we reversed items to be considered in other heads like interest income, interest expense, rental income, dividend income, all these. Then we reached operating profit before working capital changes, right? And then we gave the effect of changes in working capital, which I explained. You just have to follow this trick, okay? While solving the question, you will not think about the logic, just this trick and just do this, okay? All right. And then see, cash generated from operations we got, and then the tax paid, which you have to take as net of refund, and then you have to consider the extraordinary items relating to operating activities, and cash flow should happen of that, okay? Not just loss you will consider. Is that clear? Then finally you will get net cash flow from operating activities. After doing all this, where you have reached, you are done with the step one. You are done with the step one. You have got this figure. Let's just say here you have got 79,000. So 79,000 will come over here. Is it clear? And then you will calculate cash flow from investing activities, cash flow from financing activities, the same format, the same thing you will do. This, no difference at all. Directly this, okay? 1 lakh, 1 lakh. So 2,79,000 will come over here. Net increase in cash and cash equivalent, 2,79,000. 79, 1 lakh, 1 lakh, for example, 2,79,000. Let's just say cash and cash equivalent at the beginning you had 1 lakh, okay? So 2,79,000 plus 1 lakh you had in the beginning. So your cash at the end became 3,79,000. Is it clear? Simple and straightforward, okay? 79, 1 lakh, 1 lakh, 2,79,000 plus 1 lakh, 3,79,000. Is it clear? This is the entire format of indirect method. Really simple and straightforward. Now we have to see the adjustment. So let's start one by one, seeing most of the adjustment that we can cover in this video. Okay. Now see here we have the concept of working capital changes that we do only in indirect method. And you know the trick already. Current assets are negatively related with cash and current liabilities are positively related with cash. With this trick only, you solve in the indirect method in this format. Yeah, you give the effect of changes in working capital over here. You all know how to do this, but you don't know the logic. See, it's really simple. Working capital is nothing but current assets minus current liabilities, okay? And then there are some items, okay, which impacts the cash but not the profit and loss statement. That is why what we have to do is the related current assets and current liabilities which are there, we take them, only operating current assets and current liabilities, okay? Not all, only current assets and current liabilities which are of operating nature. We take them and we see the opening balance and closing balance of those. Opening balance means what and closing balance means what? Understand properly. Closing balance means you will find that in the current year balance sheet, closing balance. Opening balance means the previous year's balance sheet closing balance will become opening balance in this current year, okay? So let's just say, for example, debtors are there which are 7,000 and that's opening balance, and then closing balance is, let's just say, 2,000. So what has happened? Debtors have decreased by 5,000. Decrease of current asset by 5,000. Current asset is negatively related with cash. If it is decreasing, then cash flow positive impact. And here what you have to do in the format, here you have to write decrease in current asset 5,000 plus. You have to add. Is it clear? This is what you have to do. Okay, but you have to take only operating current asset and current liabilities, like for example bill receivable, bill payable, trade receivable, okay, inventory. All these are of operating nature. You have to ignore certain current assets and current liabilities which are of non-operating nature. Okay, and you also need to ignore this provision for tax. Why provision for tax? You said tax is related with operation. Understand, provision for tax is separately considered everywhere. Yeah, here I mean provision for tax is separately considered. See, we reverse provision for tax and then at last we pay the tax over here. So that is why we do not consider the changes in provision for tax in the working capital changes. Okay, is that clear? We open a separate ledger account for this if there are any adjustment or any extra information regarding provision for tax. Okay, separate ledger account will be open and there will do the adjustment of that. I will teach you, it's really simple. And then there is also dividend payable, which is a current liability. Provision for tax is also current liability. Still you have to ignore both of these things. Dividend payable, for this also we'll open a ledger account. If there are any adjustment and all, it will not be considered in working capital changes. Okay, it's a part of financing activity, dividend payable, isn't it? Yes. And then you have cash and cash equivalent. Now understand, cash and cash equivalent is what? It appears at last in the format of cash flow statement, isn't it? See here, opening balance and closing balance. So this is where it will come. Okay, you will not consider that in working capital changes, cash and cash equivalent. Is it clear? Simple. And then there are certain other non-operating current assets and current liabilities which you also have to ignore, such as outstanding interest. Outstanding interest is what? Interest that you have to pay, right? It's a current liability and it's related with financing activity. So if there is any change compared to previous year and right now, opening and closing balance, that will be considered while preparing financing activity, not right now. Okay, not in working capital changes. And same is with the interest receivable. It is a part of investing activity, interest that we have to receive in future. Okay, it is accrued but not received, so it's a part of investing activity. And same with the dividend receivable. This is also a part of investing activity. Okay, we'll consider in investing activities, not over here in working capital changes. Just ignore. And then you have short-term borrowing. Short-term borrowing is part of what? Is part of financing activity. So this also you have to ignore. Is that clear? Okay, let me just show you one question of this and then you will easily understand how to do this. Okay, see here, let me just show you. See here, we have one question, illustration 7 from the ICI study material. If you see over here, Sun Limited balance sheet has been given. 20x0, this is previous year. 20x1, this is current year. Is it clear? Okay, now see here we have current liabilities, trade payables. Trade payable is of operating nature, isn't it? Yes. So this is opening balance, this is closing balance. From 2,500 it has become 4,000. It has increased by 1,500. If current liability is increasing, that means positive impact on cash, we have to add positive. Yeah, it is increasing, we have to add 1,500 in working capital changes. Is it clear? Simple. Next current liabilities, see other current liabilities, note number 3. What is this? Let's check in the note number 3. In the note number 3, here you have dividend payable 1,000. Yeah, 1,000. So what you are going to do? See, it's dividend payable. You have to completely ignore that. Yeah, it is not related with the operation. It is related with financing. So completely ignore. For that, we have to prepare separate ledger account and all. Okay, ignore that. Short-term provision for tax. See, for provision also we have opening balance, closing balance. Okay, this also we have to ignore, isn't it? Provision for tax we have to ignore. We will separately consider that. We'll separately open ledger account for that. And then come to current assets. In current asset, you find over here current investments are given. Current investments are related with investment activity, not of operating nature. We can't consider it in working capital changes. So what are we going to do? We are going to completely ignore it. Fine. And then inventories is of operating nature. So what are we going to do? We are going to see in working capital changes from 14,000 opening balance, it has become 17,000 closing balance. So it has increased by 3,000. Inventory is a current asset. If it is increasing by 3000, that means negative impact on cash by 3000. So we have to subtract it in working capital changes 3000. Is it clear? Simple. Same with the trade receivables. What has happened? From 6000 it has become 8000. It has increased by 2000. So what we have to do? Opposite. We have to subtract. Yeah. Current asset increasing, negative impact on cash, we have to subtract 2000. Is it clear? And then we have cash and cash equivalent. This we can't consider in working capital changes. We have to ignore this in working capital changes. What will happen of this? We will take it at last. If you'll see the solution, see here at last what will happen. Cash and cash equivalent at the beginning, opening balance 8500, cash and cash equivalent at the end of period, yeah, closing balance 4000. Yeah, here we will take it, not in the working capital changes. In the working capital changes, see here, increase in trade receivable, increase in inventories, and increase in payables. Is it clear? Yeah, all are increasing. Increase in current asset, we have to subtract, and increase in inventory, we have to subtract, and increase in trade payables, we have to add. Is it clear? Okay, so you have understood regarding this. Okay, fine. So that's the thing. Now sometimes what happens is, see over here, sometimes they will not give you individual assets and liabilities. Sometimes they will just, directly give you increase in working capital 70,000, decrease in working capital 80,000. So what you have to do, remember, whenever there is increase in working capital, you have to subtract, okay? Because increase in working capital will impact negatively on cash, and decrease in working capital will impact positively on cash, okay? Working capital is same like current assets only. Why is that so? Because understand, the formula is like that. Working capital formula is current asset minus current liabilities. When working capital will increase, when current asset will increase in comparison to current liabilities, or current liabilities has to decrease. In that case only working capital will increase. So negative impact on cash, you have to subtract. Just remember the trick. To do the questions, you just have to remember the trick and do it. Okay, you can't keep thinking about logic. Logic I will teach you simply once, then every time you have to use the trick. Working capital, when it will decrease, when current asset decreases and current liabilities increases. In that case, working capital will decrease. In that case, what will happen? Positive impact will be there on cash. Okay, so you have to add in the format. Okay, sometimes that's what will happen. Increase in working capital 70,000. So you will just write increase in working capital 70,000 minus increase, right? Minus decrease in working capital, let's just say 1 lakh. So decrease in working capital 1 lakh plus. Is it clear? That's how you have to do it. Fine. Now what's the objective of doing this? Understand, there are certain items, which do not impact the profit and loss statement. They will just impact the cash flow. They don't come through, profit and loss. So what we do is we just see the net impact of current asset and current liabilities of operating nature, and we give the effect in the indirect method, so that what can happen? So that the profit can come to cash flow from operating activities. Okay, the goal of this adjustment is to convert profit from an accrual basis to a cash basis. Okay, that's the thing. Fine. Now we'll take 2 examples of debtors to completely understand the logic of this, and then you'll be perfectly clear with this. Okay, let's take those examples. Now see here, we have the example to understand the logic of working capital changes. Let's just say, for example, there is increase in debtors from 5,000 to 7,000. 5,000 opening balance, closing balance is 7,000. How much has increased? 2,000 has increased. What do we do if there is increase in current asset? We just subtract in working capital changes. Yeah, in indirect method, when we calculate cash flow from operating activities. Yeah, you all know this. Yeah, you have just applied the trick. Current asset increased by 2,000, negative impact on cash by 2,000, subtract. Simple. Okay, that's what we did. But now what's the logic? That is what we have to understand. So let's just open an imaginary debtors account, okay, with these figures. Debtors account is an asset account. Asset account always have opening balance on debit, closing balance on credit. It's always like that. So let's see here. We have debtors account, okay, opening balance 5,000, closing balance 7,000 on the debit side, credit side. Clear? Easy. Now let's just say, for example, from debtors we have received 18,000 money. How much? 18,000 money. So when we receive money from debtors, what happens? Debtors account decreases. Credit means minus for debtors account and debit means plus. Yeah, that's what it is for asset accounts. So debtors account got credited by 18,000 because we have received cash. Okay, then let's try to balance this account. 18,000 plus 7,000, that's 25,000, and 25,000 on the other side as well, and then 25,000 minus 5,000, that's equal to 20,000. Why? What is this 20,000? Why debtors has increased? Because of sales. Okay, 20,000, it has increased because of sales. We have sold goods on credit, right, in the year, so that's 20,000 sales. Okay, credit sales. Now you have to just see this ledger account and understand properly. See, 20,000 credit sales you have made. Okay, out of this, how much cash you have received? 18,000 cash you have received. Now cash flow statement plays its entire game on cash flow, entire game on cash, right? It doesn't see whether credit sales have happened, credit purchases happened and all. How much cash has been received or paid, that is what is important for cash flow. If we are preparing cash flow statement under direct method, not indirect, direct method, then what will happen? What will happen is, see, in operating activities, we'll say cash received from debtors, from trade receivables. How much? What figure you will take? 18,000. 18,000. That's the money we have received. Clear? Okay. But in indirect method, what is happening? Indirect method, what is happening? We are starting from profit and going to cash flow from operating activities. So this is what? This is statement of profit and loss. In statement of profit and loss, what will go? Will this 18,000 go? Tell me. If you know little bit accounts, then this will not go in statement of profit and loss. This cash received from debtors, no, it will not impact the statement of profit and loss. Instead, what will happen is this sales will go in statement of profit and loss. Yeah, this 20,000 sales. Profit and loss is saying that we have sales of 20,000 in the current year. Okay, credit sales. And there is no, what do you say, cash basis in statement of profit and loss. It's what? Accrual basis. So statement of profit and loss is increased by 20,000. 20,000 cash we have received, 20,000 cash we have received. That's what it is screaming. Who? Profit and loss statement. But is that true? No, it's not true. We know only 18,000 is received. So what we have to do? You will say, we will just go to statement of profit and loss. Only 18,000 should be there. Then only it will be cash basis. Then only it will be cash flow from operating activities. Isn't it? Do you understand the logic? See, the logic is credit sales made in current year of 2,000 has gone in SPL. Actually, entire 20,000 has gone. But 2,000 has gone and on that cash has not been received. On that cash has not been received. Remaining 18,000 is fine. In this remaining 18,000 is fine. It has gone, cash has been received, it's cash basis. But the 2,000, for that cash has not been received. No cash has been received for this. So what we have to do? We have to reverse that 2,000 sales. We have to reverse that 2,000 sales from profit figure. From profit figure, we have to subtract 2,000. And that's what we did with working capital changes. We saw from 5,000 it has become 7,000. 2,000 increase happened. This we have to subtract. See, in working capital changes, what did we do? Increase in current asset, increase in debtors, 2,000 we subtracted. In profit, it got subtracted. This is the net change that we are doing. Overall impact is this. Overall impact is this. 20,000 sales is sitting in SPL. Out of that, 18,000 is cash basis. Remaining 2,000 are credit sales on which cash has not been received. So what we have to do? We have to just simply subtract. That is the logic of this. Is it clear? Okay, you understood this? Fine. Now let's talk about decrease in debtors. Okay, opposite example. Now let's take another example of decrease in debtors, decrease in current asset, and let's understand the logic of this so that you'll have more clarity about this working capital changes. So see here we have debtors balances, opening balance 5,000 and closing balance 1,000. So what has happened from opening to closing? If you compare, 4,000 decrease has happened, decrease in current asset. So what do you do of it? You all know current asset negatively related with cash. So current asset is decreasing, positive impact on cash. We have to add this 4,000, isn't it? Add in cash flow from operating activities while doing working capital changes in indirect method. Yeah, we do this only in indirect method. Okay. Then what's the logic of this? Okay, we understood by the trick we have to add, but what's the logic? Let's understand the logic by doing the same thing by opening a ledger account. Debtors is an asset account. It has debit balance. Debit means plus, credit means minus. Opening balance always on debit side, closing balance always on credit side. So opening balance 5,000, to balance B by D, and by balance carried down 1,000. Is it clear? Opening balance, closing balance. Then let's just say we have received 18,000 cash from debtors. Okay, just an imaginary figure, just like that, just to make you understand the logic. Okay, by cash received 18,000. So 18 plus 1, that's equal to 19,000, and 19,000 on the other side as well. Is it clear? Okay, then we find the balancing figure. 19,000 minus 5,000, that's equal to 14,000. What is this 14,000? This is the credit sales that we have made in the current year. Okay, fine. Now tell me, how does this debtors account impact the financial statements? You will see it's really simple. Okay, see here, closing balance will go in balance sheet, right? This sales item, this is what? This is the, what do you say? Credit sales made in current year. It's a nominal account. This will go in statement of profit and loss, in profit and loss account. And this will go to the cash account, and this has to go in where? This has to go in cash flow statement. If you'll see direct method, in direct method, it should appear over here. Cash received from debtors, trade receivable 18,000, because that's the cash that we have received from debtors. So it should appear over here. In direct method, we can easily take it, right? Pick and draw. But we can't take it like that in the indirect method, because indirect method, what are we doing? We are starting from profit and we are doing all these changes to arrive at cash flow from operating activities. And you know, in statement of profit and loss, there is cash sales, there is credit sales as well. Everything goes into that. But we only need what? We only need the cash impact. We can't take all credit sales in cash flow statement. Okay. So that's the thing. So that's why we do working capital changes. So see how it will happen is the logic. See, it's really simple. How much cash we have received? 18,000. But has statement of profit and loss impacted by 18,000? No. How much it has been impacted by? Profit and loss statement has got only 14,000 sales. Profit and loss statement is saying I have 14,000. I have 14,000. But is that cash? Is that entirely cash? 14,000 is cash, but is it complete? No, it's not complete. Extra 4,000 needs to be there. It should be 18,000, not 14,000. 14,000 has gone in statement of profit and loss already, but still more 4,000 needs to go. Yeah, still more 4,000 needs to go over there. So that is why what we do, we add in cash flow from operating activities. Simple logic. Okay, so let's understand the whole picture. See what has happened is in statement of profit and loss, 14,000 has gone. But that's not enough. That's not cash basis. That's accrual basis. Okay, whatever that has been earned in this year, that is coming in statement of profit and loss, 14,000. But we have received entirely 18,000 from the previous year's debtors also. From this 5,000 also, we have received 4,000 cash. Okay, so that 4,000 didn't go in SPL, and we have to give effect of that. That is why we see the net change and we do this treatment. Okay, see, cash received from debtor, this 4,000 is of credit sales made in previous year. Yeah, and credit sale of previous year is recorded in previous year's statement of profit and loss, not in current years, because profit and loss is prepared for a year. Okay, all the current year transaction will be reflected in statement of profit and loss, income and expenses, not of previous year. So that is why this 4,000 hasn't gone in SPL, and we are giving the effect of it right now. Okay, current year SPL has not been impacted. Okay, it has not been impacted, so we give the effect right now by adding it, this inflow of 4,000. Yeah, already 14,000 has gone. We give the impact of the remaining 4,000. So completely 18,000 will go in SPL, and SPL, I mean profit and loss statement, will become on cash basis. It will become on cash basis. Previously it was saying only 14,000 sales, which was right. It was entirely on cash, but it was not complete. Complete is 18,000. 4,000 extra needs to go. Is it clear? That's the logic of this. But you will not think about all this logic and all. This is just for your conceptual clarity. In the exam, in the questions, what you have to do, you just have to do the trick. Is that clear? Okay, so you have understood the logic and everything. So now let's move on to the extraordinary items. Okay, now see here we have the concept of extraordinary items. It's really simple. We have already discussed this while discussing the format of indirect as well as direct method. So now here we are just looking at this and cementing in our mind, because that's what happens when you see the proper notes, it gets in your mind. right? So see, extraordinary items are nothing but income and expenses that arise from events or transactions that are clearly different from ordinary activities of the enterprise, okay? And these are not expected to recur frequently, okay? They do not happen frequently, okay? It happens very rarely. For example, loss due to earthquake, it's an extraordinary item. Okay, you have received proceeds from earthquake disaster settlement, it's extraordinary item. Let's just say, for example, you have filed a lawsuit and you have won the lawsuit, right? So you are going to get what? Compensation. For example, let's just say you have lost a lawsuit, then you have to pay the penalty, right? So all these are extraordinary item. You are getting insurance claim because of fire. In fire, what can happen? Let's just say, for example, there was a fire in your company, and because of fire, your goods were destroyed. Now, goods are related with operations of the company, right? It's part of operating activity. So, insurance claim received, this extraordinary item is related with goods. Yeah, so that is why this insurance claim will also become operating activity. I've told you, yeah, the whole family sits together. So, you have to remember, goods are of operating family, insurance claim on goods will also be operating family. So in direct method, what you need to do, see, understand, any cash flow associated with extraordinary items should be classified as arising from operating, investing, financing. You have to check, okay, what kind of extraordinary item it is, yeah, to which activity it relates. Easily you can understand, fine. And then you have to classify that and separately disclose it. What do you mean by separately disclose it? It means, you know, you have to take it at last. If you are talking about operating activities, let's just say we have got a, you know, proceeds from earthquake disaster settlement, then we will take it over here, plus extraordinary item relating to operating activities. Okay, if cash flow is happening, then only you will take it over here, because in cash flow statement we only, you know, think about cash. Whatever that goes in cash account will also come in cash flow statement. That's the golden tip, right? Yes. So that's how simple it is. But let's just say, for example, you have got an insurance claim because your non-current asset was destroyed by fire, the machinery, any non-current asset, okay, fixed asset. Now machinery is related with investing activity. It's of investing family. So the insurance claim received on machinery will also be of investing family. The whole family sits together, right? So what you will do of this, you will add it in investment activity. Yeah, why investing activity? Why are you adding in investing activity? Because it is related with non-current asset, PPE. Is that clear? And both of these are inflow, so you will add. Fine, I'm talking about direct method. Simple, understood. Now, what about indirect method? Indirect method also, it's really simple. See here, first what you have to do, you have to reverse all in operating activity if you start from retained earnings. If you start from retained earnings, yeah, from here, then you have to reverse everything, right? So you will reverse the extraordinary items also if they have previously been taken to P&L in statement of profit and loss. Is it clear? Okay. So that is what you have to do, isn't it? In the format we have seen, reverse all extraordinary items. Let's just say, for example, there was loss due to earthquake, you have to reverse that. There was proceeds you have got from earthquake disaster settlement, you will reverse that. Yeah, all these things. Insurance claim you have got, let's just say, for example, on loss of a machinery by fire, that also you will reverse over here, because all these items have gone to P&L. So first we reverse them. If they have been added, you subtract. If they have been subtracted, you add. That's what you do, reverse all extraordinary items. Then what you do? Then what do you do? Then the second step is, at last, separately disclosure is required, right? Yes. So at last what you will do, give effect of cash flow associated with extraordinary items at last separately in the activity to which it relates. Now understand, loss due to earthquake is non-cash, right? So that you will not consider over here. You will just take proceeds from earthquake disaster settlement. Only receipt and payment you will consider at last, not all extraordinary items. Is it clear? And it has to be operating activity only, because you're considering in operating activities, right? So proceeds from earthquake disaster settlement is a operating item. Is that clear? It's related with, you know, operating, that extraordinary item. Fine, you will add that. Then I told you there was also insurance claim received on loss of a machinery by fire. What will you do of this? You have reversed it at the top. Yes, that's right. But afterward, what you have to do, where you will consider? Can you consider it over here in operating? No, you can't. So what you have to do, you have to go in investing activity. The same format, right? Even for indirect method, investing activity format will not change. So at last you will take over here extraordinary item. What item? Insurance claim received on loss of a machinery by fire. You will add. Is it clear? This is the treatment of extraordinary item. Really simple and straightforward. This is what you have to do in indirect method. 2 steps. First, reverse everything. Second, give the effect of the extraordinary item, that cash flow, in the respective activity. Fine. And in direct method, what do we do? In direct method, I explained you already. Just do the second step. Okay, no reversal, nothing. Directly. Okay, pick and drop. That's what you have to do in direct method. Simple and straightforward, right? You have understood this. Okay, now let's move on to the provision for tax and tax paid, and let's understand that. Now see, here we have the concept of provision for tax and tax paid, and we're going to see what all adjustment can come regarding this provision for tax and how to open a ledger account and solve the adjustments. Okay, so see, it's really simple. The first thing that you should know is that the tax figure that appears in statement of profit and loss is not the tax paid. Often students think that's tax paid. It's not tax paid. Remember this, tax paid will never appear in statement of profit and loss. What will appear? What will appear in statement of profit and loss? Tax provision. Always remember that. Okay. So broadly, we call that as tax expense. If you'll see the actual format of statement of profit and loss according to the Companies Act, then it's tax expense. Now, tax expense comprises of 2 things: current tax expense and deferred tax expense. Now, deferred tax expense is entirely another topic, so we are not touching that. You will learn more about this in AS 22. Okay, not right now. Right now, we'll just discuss the relevant part. So, current tax expense, what is this? This is nothing but, the provision that you have created during the financial year. Understand what happens is, see, we are earning the income in the current year, right? And then this income will be assessed in the next year, which is the assessment year, isn't it? We have earned in a current year, and according to Income Tax Act, it's called as previous year. But this income will be taxed in the assessment year, which is in the next year, right? And at that time, when the assessment will be completed, the actual tax liability will materialize, how much tax we have to pay. But right now, we'll just estimate. Okay, on estimation basis, we will create a provision, which is called as provision for tax. Okay, so current tax expense is what? Estimated tax liability for the current financial year. Whatever provision that you have created in the current year. Is it clear? Simple, understood. So it's not tax paid, it is the provision that we create for tax during the year. Fine, that's what it is. Is it clear? It's just estimated tax liability. Now, how do we create this? It's really simple. We pass this journal entry, profit and loss account, debit to provision for tax. Fine. Is it clear? This is the entry you pass. Provision for tax is a liability account. When it gets credited, it increases. And profit and loss also has credit balance. So we are using the profit and loss. Okay, so it's getting debited. It's decreasing, isn't it? So that's why profit and loss account is getting debited. Fine. Then tell me the treatment of provision for tax. What did I tell you when we discussed the format? What do we do of provision for tax? We simply reverse it, right? In indirect method, we just reverse it. It's a non-cash item. Yeah, we haven't paid anything. It's just a book entry. We have just created a provision, estimated tax liability of the current year, right? So how and when you are going to reverse? It's really simple. You're going to add this to reverse, because normally it is subtracted. Yeah, normally it is subtracted. So to reverse, you will add back. But when you will add back? Only when your starting point in indirect method is retained earnings and net profit after tax. Yeah, in these 2 cases only you will reverse that. If you have got net profit before tax in the question, are you going to reverse tax provision? No, you are not going to reverse. You all know that. So reverse it if your starting point is net profit after tax or retained earnings. Understood? Easy. Then the tax paid. Yeah, whatever tax that is paid, yeah, that is what? Cash outflow from operating activities, isn't it? Yes, you all know this. You have seen in the format also. Yeah, in the format, if I show you the indirect method format, see, tax paid is subtracted by taking net of refund. I've already discussed that. In operating activities, you just deduct. Even in the format of direct method, you just subtract, right? Tax paid, isn't it? Simple. So that is what you have to do, subtract it at last in, operating activities. It's a cash outflow, same in both methods, and you have to take net of refund. Is it clear? This is the concept of provision for tax and tax paid. Now there can be adjustment of this. So when there are adjustment, what you have to do, remember in cash flow statement chapter, whenever there are any adjustment of any item, you have to open a ledger account. In the ledger account, you can clearly understand what is happening, okay, and how cash is being impacted, and that effect you can easily take in the cash flow statement. Okay, so see here, let me just show you the format of provision for tax account. See here, provision for tax account, it's a liability account. All right, yes. So debit means minus and credit means plus for this account. It has credit balance. So opening balance will come on the credit side and closing balance will come on the debit side. It's always like that for liability account. Is it clear? Okay. Then whatever provision you create during the year, it will come on the credit side as by profit and loss account. Why? Because understand, what was the entry? Entry was this, right? Provision for tax account got credited because of profit and loss. Yeah, we created out of profit and loss the provision. Yes. So provision for tax, it increased because of what? Profit and loss. Fine. So it will always come over here because you're creating the provision during the year. So it is increasing. It will come over here. And then when the tax is paid, what happens? Provision for tax account will decrease. Okay. We set it off. Is it clear? So whenever tax is paid, it will come over here. Is it clear? So there can be so many adjustments. See here, let me just show you one adjustment. First adjustment, see, let's just say provision for tax is given in the balance sheet. Okay, opening balance, closing balance is given. What you will do? Opening balance will come over here, closing balance will come over here. Is it clear? Then let's just say in the question they have told you tax paid is such an amount, right? So you will take over here and then you will find balancing figure as the provision that is created during the year. Is it clear? Yeah, see here, open ledger account for provision for tax, find current year provision for tax as a balancing figure. I've just told you how to do that. Let's just say, for example, second type of adjustment, opening balance, closing balance is given. You will take opening balance, closing balance. Okay. And then in the question, they have told you how much provision has been created during the year, current year provision for tax. So you will take that over here. And then what will happen? This you have to find as a balancing figure. Okay. Suppose, for example, let's see, this is 4, this is 6. So 4 plus 6, 10. So 10 over here, let's just say this is 3. So 3 you have written over here, it's given in the question. 7 would be the tax paid. Like that. Okay, balancing figure. Open ledger account for provision for tax, find tax paid as a balancing figure. Is it clear? Then, let's just say, for example, nothing has been said. Just opening and closing balance are given. Then what you will do? If just opening balance and closing balance are given, then you will make an assumption. Assumption is that opening balance is paid during the year. Okay, opening balance is paid during the year. Okay, opening balance, whatever amount you have, you will take opening balance, closing balance. Then you will assume opening balance is paid, the same amount you will take, and closing balance is the, the provision that is created during the year. This assumption you will use. Is it clear? See here, assume this as tax paid and assume this as current year provision for tax. This we also do for dividend payable. Okay, when we'll discuss that adjustment, you will come to know about that also. Is it clear? This is what you have to do. Okay, let's just say opening balance is 4 and closing balance is 6. So 4 is the tax paid and 6 is the current year provision, also the provision created during the year. Fine. Is it clear? Now what is the treatment? Treatment you already know. Whatever tax we pay in both the methods, we have to subtract from operating activities, and then whatever provision that we create during the year, not the balance sheet item, whatever that we create during the year, the provision for tax, that we have to reverse in operating activities only in indirect method if we start from net profit after tax or retained earnings. Is it clear? This is what you have to do. Okay, and then here I have written, see here, the tax paid, the income tax paid is operating activity, you already know that. And then I've told you, if we sell any building, a long-term asset which is related with investing activity, isn't it? Then the tax paid on that, the long-term capital gain tax, that will also go in investing activity. The whole family sits together, right? And then there used to be dividend distribution tax. Now it's abolished, right? But still, I have to just explain you the concept. Let's just say, if company pays the dividend, they are paying dividend distribution tax. So dividend paid is a financing activity. Any tax paid on dividend distributed, that will also become a financing activity. Is it clear? Yeah, it's abolished now, but it used to be there. Is that clear? So that's how it is. Okay, whole family sits together. You have to see the relation and easily you can identify in which activity it falls. And then refund of tax. Now refund of tax also is really simple. I have already explained you everything. In indirect method, we reverse it in operating activity. If you start from net profit after tax or retained earnings, yeah, you reverse the refund of tax. And then what do? You deduct the tax paid by considering the refund. Yeah, when you subtract the tax paid in operating activity, let's just say tax paid is 10 and 2 is refund. So 10 minus 2, 8. 8 you will subtract in operating activities. Yeah, the same treatment. Whatever we have discussed, I'm just showing the notes over here. Is it clear? The only new thing you understood was how to create the ledger account. Is it clear? Right. So that's all about the provision for tax and tax paid. I hope you have understood this. And as I said, there are 3 adjustments in this. Okay, there are 3 adjustments. Fine. Now let's go to the next adjustment. Now let's understand the adjustment of dividend paid. You all know dividend paid is a cash outflow from financing activity, right? We just deduct that in financing activity. But an adjustment can come on that, and in the question you will find in cash flow statement question, they are saying dividend payable, proposed dividend is paid of this much, right? Interim dividend. So all these adjustment we have to understand right now. But first, we need to know a little bit basics about how the company pays the dividend. So you have to understand this from the company's point of view. So let's understand this. See here, it's really simple. There are 2 types of dividend, final dividend and interim dividend. Let's talk about final dividend first. See, what happens is board of directors, they will propose the final dividend. They will recommend the dividend after the date of balance sheet. Okay, because that's when they will get to know how much profit we have made in the current year, right? After the date of balance sheet. So this is a non-adjusting event according to the AS4, the revised one. So that is why no accounting will happen of proposed dividend. What is proposed dividend? The dividend that is proposed by the board of directors, what they have recommended. Is it clear? So in the balance sheet, it will just be disclosed in the notes. Is it clear? Simple, understood. Then what happens is, see, after the date of balance sheet, within the next 6 months, yeah, from the close of financial year, yeah, that means in the next year, right? Dividend is of current year, but in the next year now we have to do something. Understand, within 6 months from the end of financial year, AGM must be held. You all know this. Yeah, the end of financial year is when? 31st March. So till 30th September, within this period, AGM must be held. So in AGM, what will happen is shareholders should approve the proposed dividend. Whatever dividend that is recommended by the board of directors, it will be accepted by the shareholders. Is it clear? Their approval is required. When they give their approval, it means shareholders have declared the dividend. And usually they will give the approval and they will accept the same amount only, usually the same amount as proposed by the board of directors. Either they can reject or they can approve. Yeah, they cannot increase the amount. Is it clear? Okay, fine. So dividend will be declared. When dividend is declared, that means the company now has to pay the dividend. So we have a dividend payable. Dividend has to be paid to the shareholders now. So we have to do the accounting of this and understand it has to be paid within the next 30 days since the date of declaration. Is it clear? Simple? Yes. Now what will be the entry of this? See, the entry is really simple. You all know dividend is distribution of profit, right? So it can't go inside the P&L account, right? It is a part of appropriation. Yeah. If there are preference shares, then preference dividend will also be given first and then the equity dividend chance comes, right? So final dividend will come over here. It's a part of appropriation. Fine. Final dividend. Is it clear? So see here, P&L appropriation account debit or surplus account. Surplus account means what? Retained profit. Okay. Balance in P&L that we have, right? So you will debit either of these two and you will credit the dividend payable. A liability will be recognized that within next 30 days we have to pay this amount to the shareholders. Is it clear? So when you will see the cash flow statement question, you will find in the balance sheet other current liability, they are saying dividend payable. So you have to understand what is that dividend payable. That is the dividend that they have declared. The dividend they have declared, the company has declared. Is it clear? Understood? Okay, fine. And one more thing, see, dividend, final dividend I'm talking about, dividend of 2023 will be paid in 2024. This is what happens regarding final dividend. Final dividend will be of a certain year and it will be declared and paid in the next year. Okay, this is what happens. Fine. And then we have something called as interim dividend. Now, what is interim dividend? Interim dividend means a dividend that is paid between two annual general meeting. Okay, and for interim dividend, the approval of shareholders is not required. Directly, the board of directors, they will only declare the dividend. Okay, there is no concept of propose and all. They will directly declare the dividend, board of directors. It is declared and paid in the current year itself. Is it clear? Declared by board of directors. And the entry is almost same only. Okay, the same net effect is there. So for both of these dividend, we'll prepare only one ledger account for adjustment. Okay, we'll just open dividend payable and same sort of entry will be passed and easily we can do that. Is that clear? Now let's discuss the adjustment and you will understand how simple it is. Now see here we have the adjustment of dividend payable. It's really simple. First, let's understand the ledger account of dividend payable. You all know dividend payable is a liability account. So it has credit balance. That means the opening balance will be on the credit side and closing balance on the debit side. Okay, right. Then whatever dividend that we declare will come over here by profit and loss. Dividend declared in current year. Okay, because see the journal entry. I showed you the journal entry. The journal entry is P&L appropriation account or surplus account to dividend payable. Dividend payable account is getting credited. You all know for liability account, debit means minus, credit means plus. So dividend payable account is getting credited. It is being increased because of P&L. That's the logic. Okay, right. So that's the thing. And then whatever dividend that is paid in the current year will come over here. Dividend payable will decrease. When you pay the dividend, what happens? Dividend payable liability will decrease, right? So dividend payable will decrease because you have made the payment. That is the logic of this ledger account. Okay, so what you have to do is whenever there is any adjustment of dividend payable or proposed dividend, you have to just open this account. Take the opening balance over here, closing balance over here, and then the question says this much dividend has been declared. Just take that over here. Find the dividend paid as a balancing figure. For example, let's just say this is 5 and this is 2. Okay, and here you have 10 dividend that is declared. So 5 plus 10, that's equal to 15, and here also 15 minus 2, that's equal to how much? 13 is the dividend paid. That's how you have to find out. Is it clear? Okay, now what is the treatment that you do in the format? See, I have written already over here. In direct method, what do? You just deduct in financing activity whatever dividend that is paid. Simple. In direct method, you know, nothing is difficult. It's really simple in direct method. Yeah, dividend paid, you will take 13 as I said. Is it clear? Simple. In indirect method, what happens in indirect method, you know, first you have to do reversal. So now what you will reverse, that is what you have to understand. You can't reverse both the things. See, understand properly. What you will reverse over here in indirect method, in the appropriation reversal, what you will reverse? You will reverse interim dividend paid. Okay, because interim dividend paid is declared and paid in current year only, right? So whatever interim dividend is paid, you have to reverse that over here. Regarding the final dividend, what you have to do, whatever dividend that is declared in current year, yeah, only that you will reverse. Is it clear? Reverse in operating activity if you start from retained earnings, and that's also very important. You can't reverse all the time. When you will reverse only when you start from retained earning figure, from this, yeah, profit after all adjustment. If you start from net profit after tax or before tax, you can't reverse dividend, yeah, because it has not been subtracted. How can you reverse? You can't reverse. Only when you start from retained earnings, then only you will reverse this. So the objective of preparing this account is what? To know how much dividend is paid, to know how much dividend is declared. This we have to reverse in operating activity if we start from retained earnings, and this we have to deduct in financing activity in both the methods. Direct or indirect, we have to deduct. Yes. Now, one sort of adjustment can come that is little bit tricky. So that is what we are going to understand right now. See here, if for example, let's just say dividend payment in current year is not given. This is not given, how much dividend is paid. But opening and closing balances of proposed dividend and dividend payable is mentioned. Yeah, sometimes they can say proposed dividend or dividend payable. Mostly in the new material, dividend payable only. Old, they used to say proposed dividend, right? So dividend payable, they will say, okay, opening balance, closing balance. So what you will do, simply see here, this is how it will be given in the balance sheet. All right, opening and closing balance will be given to you. So what you have to do is understand, you have to make an assumption, and it will be a rational assumption. Okay, see, understand, you have to see opening balance. What is this opening balance? This dividend payable is from the previous year, right? So that means it is declared in previous year, and you all know dividend has to be paid within 30 days since the date of declaration. So obviously you can clearly assume, yeah, you can, rationally assume that the dividend has been paid in current year. It must have been paid in current year, right? So this amount you will assume as dividend paid, and the closing balance you will assume as declared in the current year, right? This is the rational assumption. We do this assumption for provision for tax also. If just opening and closing balance are given, what do? Opening balance, you assume that it has been paid, tax paid, and closing balance is the tax provision during the year. Fine. The same sort of assumption over here also. Opening balance is the dividend paid and closing balance is the dividend declared. So in the ledger account, if you open the ledger account of this, then what will happen? Opening balance, closing balance you will take. Okay, let's just say 5 and 2, the same example. So you will assume 5 is the what? This is the opening balance. So opening balance you are assuming it's paid. So this 5 will come over here, 5. And this 2 will come over here, 2. Dividend declared in current year. Is it clear? This is how it will happen. Okay, this is a little bit tricky adjustment that can come. You have to understand that. And if interim dividend comes, then remember, interim dividend will be declared also. It will come in this figure also, and it will come over here also. Now don't worry, when we will solve the problems, you will feel this is nothing. Easily open the dividend payable and find out as a balancing figure, and easily you can do this. Is that clear? So that's all regarding the dividend payable adjustment. Now we have to understand about dividend income. When we receive the dividend, what kind of adjustment can come? Let's discuss that. Okay. Now see here we have dividend received adjustment. It's really simple. The first thing that you should be clear in your mind is that this dividend received adjustment is completely separate from dividend paid adjustment. Don't mix them up. These two are separate things. Dividend paid is a financing activity. Dividend received is an investing activity. All right. Okay. So first let's understand what is the normal treatment that we have been discussing about dividend received, let's just say 50,000. What do we do of that? While discussing the format, we have talked about this. So what do we do? First, tell me what happens in final accounts, in financial statements. In financial statement, you will say, when we prepare statement of profit and loss, if we have got the dividend, then we just take it in indirect income. It goes inside the P&L account, right? Isn't it? 50,000, it will be added as an income, indirect income. Yes, that's correct. So in cash flow statement, what happens? While discussing the format, we have discussed this. If we talk about direct method, what happens is directly pick and drop. It's a part of investing activity. We have got 50,000 dividend. So dividend received 50,000 add. Yeah, that's what we do in investing activity. What do we do in indirect method? In indirect method, you all know this dividend received has already gone to P&L, 50,000 as an indirect income. It has been added. It has been credited. So what do? We reverse items to be considered in other heads. It's an outsider. Dividend received 50,000. Yeah, it's of investing family sitting in operating family right now in indirect method. So we just reverse it. Dividend income, dividend received, we just reverse it. How? We subtract 50,000. Is it clear? Understood? Easy. Okay. And then in investing activity, what do? We will add that 50,000. I'm talking about indirect method. You will do investing activity also, na? So you will add 50,000. Clear? Easy. Clear. Now this is called as post acquisition dividend. Just now we discussed, right? All this, that's post acquisition dividend, which was credited to P&L while preparing final accounts, financial statements. It was a normal dividend income. Now in cash flow statement, what do? In indirect method, we reverse in operating activity by subtracting it, and we add in investing activity. If you are talking about direct method, then we just add in investing activity. No reversal, nothing. Yeah, it's direct method. Is it clear? Okay, understood. We understood what we have to do post acquisition dividend, but we still don't know what's the meaning of post acquisition dividend. Let me tell you. See, Imagine there are 2 years. Okay, there are 2 years. So there has been AGM over here, annual general meeting. Okay, in the annual general meeting, board of directors have board of directors have proposed the dividend, shareholders have declared the dividend. Now this dividend which has been declared, you have to remember, this is a final dividend, and this dividend is actually of previous year. This dividend is actually of previous year. Is it clear? So if you were the owner of the shares in this complete previous year, then this dividend which you have got right now in the next year, this will be called as post acquisition dividend. Okay, you were the owner of the shares in the previous year, you have got the dividend, it's a normal dividend income. Okay, so that's what it is. It's the same treatment, just now what we talked about, right? That only. Is it clear? It can also happen, see, 2 years are there. Let's just say in the current year only you purchase the shares. In the current year only you purchase the shares before the record date. So in the company record, your name has come. Yeah, the shares have been transferred to your name. So you will get the dividend even though you were not the owner of the shares in the entire previous year. Dividend is of previous year. It has been just declared and paid in the current year, and you are getting the dividend. But you were not the owner of the shares in the previous year. You were not supposed to get the dividend actually. The system is like that you got the dividend. But if we see properly, you purchase the shares in the current year only. You are the owner of the company, yeah, of the current year only, not in the previous year. So how can you get the dividend? How can you have right on the previous year's profits? You can't, right? So what happens is, normally, see, the share prices in the current year will be already inflated. The whole market overall will know that dividend is going to be declared soon based on the past history of the company, and price of the share has been inflated. You purchased at inflated price. So this is your cost of shares. This is your cost of investment. So if you are getting dividend of 50,000, let's just say, this 50,000 dividend is not your income because you were not the owner. This is not your income. What you will have to do then, see, this 50,000 which you have got, the standard says you have to deduct it from cost of investment. This is not your income. This is your recovery of cost. You purchased at an inflated price, right? The dividend element was included in that. Dividend was factored in that, right? Nobody will sell their shares at a low price. They will sell at an inflated price only. Overall, the market effect will come into the picture and it will be at inflated price. So pre-acquisition dividend means that kind of dividend. Yeah, you are not the owner of the shares in the previous year for which the dividend has been declared, but you are getting the dividend because of the system. Okay, so you have to reduce it from the cost of investment. Is it clear? It is not your income. It should be deducted from investment account. In cash flow statement questions, what will happen is, for every adjustment you will open ledger accounts. For investment account also, if there is any adjustment, you will open that when there is pre-acquisition dividend. Okay, so at that time in the investment account, what will you do? You will take it on the credit side, pre-acquisition dividend. In the working I'm talking about, yeah, in the working note. Is it clear? Yeah, right. And it will be reduced from the cost of investment. It is not your normal income. So when we prepare the financial statements, I'm not talking about cash flow, okay? When we prepare the financial statement, final accounts, what happens? This pre-acquisition dividend doesn't go over here. It doesn't go in indirect income. Is it clear? It doesn't go. So that means if we are preparing cash flow statement from indirect method, then we will not reverse over here, even though we have received dividend of 50,000. But previously it has not been taken to P&L, na? It has been reduced from cost of investment. That's what has happened. Okay, in investment account it has been deducted. So it has not gone into P&L, so you will not reverse. Then what you will do in cash flow statement? Tell me. What you will do? It's an inflow, right? It's a cash inflow, right? From investing activities. So you have to consider it an investing activity. Reversal is not required, but you have to take over here 50,000. Direct or indirect, you have to take it in investing activity. Okay, pre-acquisition dividend also. Is it clear? You have to add it. Is it clear? Understood? Simple. But sometimes what can happen? Wrong treatment can happen. Okay, this is the toughest adjustment of this that can come. If wrong treatment has been done, wrongly credited to P&L, yeah, while preparing financial statement, they have done a mistake. Pre-acquisition dividend has been taken to P&L. If that mistake has been done, It is a very rare mistake, but if that has been done, then still you have to do reversal in operating activities under indirect method. Okay, don't worry, you will understand all this, okay, when we'll do the question. Fine. But normally what do you get? Normally you get post acquisition dividend only, and you have to be very clear. Only when the question says you have to do this pre-acquisition dividend, otherwise always you have to assume it's post acquisition dividend, and simple treatment you have to do. It has been credited to P&L, normal dividend income. In indirect method 2 steps, indirect method just this black last step. Is it clear? Okay, now this is the journal entry for what do you say, pre-acquisition and post-acquisition dividend in financial, when we prepare the financial statement, that is bank account debit to investment account to P&L account. Yeah, when we get the dividend, let's just say we have got 80,000 dividend. Out of that, 50,000 is pre and 30,000 is post. So what will you do? Bank account debit 80,000 to investment account 50,000 to profit and loss 30,000. Is it clear? Whatever that is of post, that will go in profit and loss. Whatever that is of pre, that will be deducted from the investment. Investment is an asset account, it has debit balance. We are crediting and decreasing the investment balance over there. Yeah, the cost of investment, it's like that. And if you want to see the effect over here right now only, how the treatment will be done in cash flow, then understand this entire 80,000, the dividend that has been received, it has to be added in investing activity because that's a cash inflow from investing activity. But in indirect method, what do? We reverse the dividend that has been previously taken to P&L. Yeah, how much is taken? 30,000 has been taken to P&L, so that we have to reverse in operating activities. Is it clear? That's how it is done. Fine. Okay, and then in the pre, just reduce from the cost of investment. When you prepare the working note in cash flow statement question, there you will have to consider that. Okay, so that's all regarding dividend received adjustment. Now let's see accumulated depreciation and depreciation adjustment, okay, of PP. Now see here we have adjustment regarding depreciation. See, we charge depreciation on what? On property, plant and equipment. Yeah, tangible fixed asset like machinery, vehicles, all these things, right? So there are different methods to calculate the depreciation. That's not important for us. What is important is how do we account for the depreciation. There are two ways to do the accounting treatment of depreciation. One is the charge method and another one is accumulated depreciation method, right? Charge method means directly we are charging the depreciation in the asset account only. Everything is happening in asset account. Accumulated depreciation account means, you must remember in CA foundation in class 11 you have learned provision for depreciation, right? So in that, here what we do is we keep the machinery account or the asset account, PP account, on original cost only. We do not charge depreciation on that. We open a separate account called as provision for depreciation or accumulated depreciation, and we charge all the depreciation in that, right? All the depreciation will be collected over there, and it's a contra asset account, or you can think it's a liability account opposite to asset. Okay, it has credit balance. And then whenever we sell any asset, then what we do in this case, that also we do not consider in machinery account, the asset account. No, we open a separate account for that called as asset disposal account. Okay, like that it is in accumulated depreciation. So now in cash flow statement question, what will happen is the company can follow this also, this also. Okay, so if the company is following this method, then easily you will come to know, because there will not be any mention about provision for depreciation or accumulated depreciation. So you will, think this is being followed and you will do the treatment accordingly. What is the treatment? I will teach you, don't worry. Just understand the overview right now. But if you see in the question, in the balance sheet or anywhere, accumulated depreciation account or provision for depreciation account, that means you have to understand the company which I have got in this cash flow statement question is doing this accounting treatment. So I have to do, this, okay, this sort of adjustment. All right. Okay. So now let's understand what happens in charge method first. In charge method, as I said, everything is charged in the machinery account. Now this asset account, this PP account is what? Asset account, right? So it has debit balance. Debit means plus and credit means minus. And debit balance it has, so opening balance will be on the debit side, closing balance will be on the credit side, right? So when you purchase the asset, what happens? Asset increases, right? And you have to pay something, so you will pay money to cash or bank. It's purchase. Is it clear? When you sell the asset, what happens? Asset decreases, right? And you get the money, sale value you get. What do you get? You get sale value. So buy cash or bank, sold. Is it clear? Yes. But when you sell, what happens? Either you make profit or you make loss. If you make profit, it will come on the debit side. If you make loss, it will come on the credit side. Is it clear? To profit and loss, buy profit and loss. Fine. And then what will happen? Maybe you have purchased asset, machinery by not paying cash. You have issued bonds of your company. You have issued debentures of your company. Maybe you have issued equity shares of your company to the seller. Yeah, you are getting asset, you are giving shares, you are giving debentures, you are giving bonds. It can happen. In that case, what you will do? How you will do the posting in the ledger? Machinery is increasing. You have purchased. What you have given? You have given bonds, you have given debentures, you have given, let's just say, equity shares. And let's just say equity shares at premium, then 2 equity shares and 2 securities premium will also come over here. Is it clear? I'm teaching you the logic of preparing ledger account, the basic thing. Okay, understood? All right. Then at the year end, you have to charge the depreciation also. So how do you charge the depreciation? Depreciation will be calculated according to the method. Don't worry about that. You will find out mostly the depreciation as a balancing figure. So how do we take the depreciation? See, what do we do? Asset decreases because of depreciation. Depreciation is decrease in the value of asset, right? So machinery account is getting decreased because of depreciation. Is it clear? Depreciation is directly charged in the asset account. That's what charge method mean. Everything happens in asset account only. Is it clear? Right. And this is the opening balance. This is the closing balance. Opening balance on the debit side, closing balance on the credit side. Clear? You understood how to prepare the machinery account. Now let me tell you how the effects of this will flow in cash flow statement. First, understand purchase and sale of machinery is what? Is investing activity. Purchase of machinery is outflow of cash and sale of machinery is inflow of cash. Where it will come? It will come in investing activity. Isn't it? Yes, we all know that. It will come in investing activity. See here. Purchase of fixed asset, proceed from sale of fixed asset. It will come in investing activity. See, investing minus, investing plus. Is there any doubt in that? No doubt. It's simple. Okay. Then, loss on sale, profit on sale. What are these things? These are non-cash items. Loss on sale, profit on sale. These items have been taken to profit and loss. These items have been taken to profit and loss. They are sitting. See, loss on sale is an indirect expense and profit on sale is an indirect income. These are sitting over here. What we have to do, we have to reverse non-cash. So we will reverse them. We will reverse them. Okay, reverse non-cash. See here, in the indirect method format, reverse non-cash and non-operating items. Gain on sale of land, loss on sale of machinery. You have to reverse these things. Is it clear? Loss on sale of machinery will be added and profit on sale of machinery will be subtracted. Okay, you have to do opposite and you have reversed them. Is it clear? Okay. And then whatever equity shares, bonds and debentures you are given to purchase the machinery, that will not be considered in cash flow statement because they are not affecting the cash flow. You have got the machinery and you are giving the shares, you are giving the bonds, you are giving the debentures. So where is the cash? There is no cash. If there is no cash, then it will not go in cash flow statement. Simple funda. Is it clear? Okay, understood. Then the most important part, the depreciation. Depreciation you will mostly calculate as a balancing figure. Most of the figures will be given to you. Okay, you will do everything, you will do the total, and as a balancing figure you will find out the depreciation that is charged in the current year. Okay, this figure you will get as a balancing figure mostly. So you will reverse that in operating activity. Yeah, same like loss on sale. You will add it, right? Depreciation will be added back because normally depreciation is deducted in statement of profit and loss. It's an expense. So now you have to add back and reverse it. Is it clear? That's what you have to do. Why did we prepare this machinery account? What was the reason? The reason was to just know the depreciation that has been charged in the current year. Is it clear? Understood this? Simple. Now let's understand accumulated depreciation account. Now see here we have accumulated depreciation account. It's really simple. It's also known as provision for depreciation. If you look into the question, you find either of these two terms and all, you have to understand this sort of treatment is being done and you have to prepare these ledgers to find out the figures. Okay, so see here. Here what happens is, here machinery account, the asset, the PP account will stay at original cost. You will not charge the depreciation over here. You will not sell the asset over here. You will not take profit or loss on sale over here. What will happen here? You will just have opening balance of the asset, closing balance of the asset, right? Any asset you have purchased, and if you have purchased the asset, it will come over here, right? If you have purchased the machinery, it will come over here. It's the same way. If you have purchased the machinery by way of issuing bonds, equity shares, debentures, it will come over here as usual. Just the depreciation will not be charged over here. The sale will not happen over here. The profit or loss also will not come over here. Is it clear? That's the difference. So when we sell the asset, what will happen? When you sell the asset, just remember, you have to just delete the, original cost of the asset that you have sold. How will you delete? Machinery account, you have to decrease by that much original cost of the asset which you have sold. And you will take the name as buy asset disposal account. That means you are opening a separate account called as asset disposal, okay, for the asset that you have sold. Is it clear? Understood the logic of this? So how this account will affect the cash flow statement? Simple, one effect will go. See, whatever asset you have purchased by paying cash, that you have to deduct in investing activity. Is it clear? Understood. Then you have to prepare accumulated depreciation account. It's what? It's a provision for depreciation. It's a contra asset account, or you can say it's kind of like a liability account, right? It's kind of like liability account. Now see, this is accumulated depreciation account. Now what will happen in this account? In this account, you will park all the depreciation that you have charged till the date. All the depreciation will be collected over here. You are not charging the depreciation over here now, so you have to show the depreciation somewhere. So here in this account, it will be getting collected. Fine. So there will be opening and closing balance of this, which you will get from balance sheet. So opening balance, closing balance you will take. Accumulated depreciation account is kind of like a liability account. It's a contra asset account actually. Okay, fine. So it has credit balance opposite to asset. Okay. So opening balance on the debit side, closing balance on the credit side. Credit means plus, debit means minus. Fine. So opening balance, closing balance you understood. Then the depreciation which we charge will come over here. And mostly this will be found as a balancing figure. Opening balance you will take, closing balance you will take. If the question says some of the asset has been sold and this much is the depreciation of that asset charge till the date of sale, you will take over here. To asset disposal. Yeah. To asset disposal. What you will take? Whatever depreciation is there of that sold asset till the date of sale will come over here. And then as a balancing figure, you will find out how much depreciation has been charged in the current year. Is it clear? Current year depreciation you will get over here. We prepared this accumulated depreciation account to get the current year's depreciation. Is it clear? Okay. How the effect of this will flow to cash flow statement? Really simple. You will just get to know current year depreciation, which we have to reverse in operating activity under indirect method. Right? Here. This thing. Fine? Understood. We understood why we prepared this ledger account. Then we have asset disposal account. Now what is this asset disposal? Why do we prepare this? We prepare this asset disposal account because we get to know the sale value of the asset, okay, how much profit or loss we have made. That's why. Okay, in asset disposal account, two posting will come, one from machinery and another from accumulated depreciation. Okay, cross posting. See here, by asset disposal is there, it will come to machinery, original cost of the asset that you have sold. Okay, and here to asset disposal is there, depreciation till the date of sale of that sold asset. Okay, that will flow over here by accumulated depreciation. Is it clear? Understood. Okay, original cost of the asset and then how much depreciation till the date of sale. Okay, since when you purchase from that date to till the date of sale, that will come over there. Fine. And then the sale value you have to take. At what price you have sold it, at what amount you have sold it, will come over here by cash or bank, the asset which you have sold. Fine. And then as a balancing figure, you will find out whether you have made profit on sale or loss on sale. Always remember, profit will come on the debit side, loss will come on the credit side. Is it clear? Understood? Simple, right? So now how the effect of this will flow in cash flow statement, that is very important because that's why we are preparing this. See, we have sold the asset, so that's the sale value we have to add in investing, isn't it? Purchase and sale of asset will be where? Investing activity. Purchase of fixed asset, proceed from sale of fixed asset. Fine. And then the profit or loss you have to reverse in indirect method. Fine. So this is what it is, asset disposal account. Clear? Okay. So that's it. Let's move on to the next adjustment now. Now see this adjustment, profit on sale of an asset when it has been transferred to capital reserve. Okay, what we have to do in cash flow statement. First, think about the normal treatment. Profit on sale of an asset, just now we saw in the machinery account. In the machinery account, we saw profit comes on the debit side, right? And we take that to profit and loss. That's what usually happens. If it has been taken to profit and loss, that means what? It means in statement of P&L, it is sitting in indirect income, right? And we are converting this to what? We are converting this to cash flow from operating activities. So what we have to do, we have to eliminate this non-cash item, isn't it? So we, reverse over here, gain on sale of land, profit on sale of machinery, profit on sale of building. Is it clear? That's what we do. We just simply reverse it. Yeah, that's the usual treatment. Yeah, reverse in operating activity. Now, if the question says profit on sale of an asset has been transferred to capital reserve, what does that mean? Visualize the asset account, the machinery account. Yeah, the profit is on the debit side, but they have not written to profit and loss. They have written to capital reserve. That means the profit on sale hasn't gone to profit and loss statement. It is not sitting in the indirect income over here. So while doing the cash flow statement as per the indirect method, you cannot reverse because profit and sale is not included over here. Is it clear? So what you will do, if this is transferred to capital reserve, nothing, you will just ignore it. You will just ignore it. Is that clear? Yeah, it's just that when you prepare the working note in the asset account, in the machinery account, whatever the asset is, it's just on the debit, you have to write capital reserve. Okay, just the working note. Fine. In cash flow statement, nothing will happen. Fine. You will not reverse. How can you reverse? It has not gone to statement of P&L. You cannot reverse. Is it clear? Yes. But sale of an asset, where do you consider sale of an asset? Do you remember? It doesn't matter where it has been taken or which method it is. Sale of an asset has happened means what you have to do? Proceed from sale of fixed asset. You have to take the whole sale value. Okay. This is a normal thing, not related with the adjustment. Is it clear? Okay. Understood. Next adjustment is, see, question can be silent on sales and purchases, whether they are cash or in credit. Is that clear? In that case, you have to write a note down below and you have to make an assumption that all are on credit. Okay, if nothing is specified about cash sales or cash purchases, you will assume total sales and purchases are on credit only. Is it clear? Okay, now let's move on to the next adjustment. Now see, here we have the interest adjustment. Okay, interest paid adjustment, and this is a hidden adjustment. The question will not specify this. The question will not tell you anything about this. You have to do this in every question. Is it clear? See, in the balance sheet, for example, let's just say debentures are given, long-term loan is given, or any other loan is given, and along with that rate is given. Okay, 10%, 11%, 9%, like that. So what you have to do, you have to calculate always the interest on debenture or that loan. Okay, and you have to reverse in operating activity, and you have to what? Deduct in financing activity, because that is what you do with the interest that is paid. This is interest paid adjustment. Okay, interest paid is a financing activity. That's fine. We will deduct in financing activity. It's a cash outflow we have paid. Yes. Now interest paid also goes where? It also goes in statement of P&L, isn't it? It is sitting over here, indirect expense, interest that we have paid. It's a finance cost. So in indirect method, yeah, in indirect method, what we have to do, interest expense, the interest that we have to paid, it's an outsider. We have to kick it out. Interest paid is usually deducted in a statement of P&L. So now what we have to do, we have to add. Yeah, we have to add and reverse it. Is it clear? Reverse items to be considered in other heads. That is what you have to do, these two things. Reverse in operating activity, and then you have to subtract in financing activity. See, in financing activity, interest paid, you have to subtract. Is it clear? Yeah. So always you have to do this. And then there are certain fake adjustment. The question will talk about bad debts. The question will talk about discount allowed. The question will say discount received. Okay, and then the question can say something about stock valuation. All these adjustments you have to completely ignore. Why is that so? Because see, the effect of this has already gone to statement of profit and loss. And regarding this, what we do, we do something called as working capital changes. You all know that, right? We take the operating current assets and current liabilities and we see the opening balance and closing balance. Is it increasing or decreasing? Yeah, we compare and we see whether this current asset, debtors, is it increasing or decreasing? Current liabilities, for example, trade payables, is it increasing or decreasing, right? And we give the net effect in the format, right, over here. So when we do this, all this is already considered in the net effect, right? So that is why we do not do any separate adjustment of this. If we do any separate adjustment of this, still the effect will be same only, because it gets nullified over here. So that is why don't do all this. We'll just do working capital changes. Is it clear? Yeah, that is why I also told you, in non-cash items, I told you you have to reverse only what? You have to reverse only non-cash items which are of non-operating, like depreciation, profit on sale, loss on sale, for example, preliminary expenses written off, discount on issue of debenture written off, all these things, right? Not bad debt, discount allowed, discount received and all. Why? Because we do changes in working capital for that, and the effect of that has gone to P&L already, and working capital changes is enough for that. Is it clear? Okay, understood. Now let's move on to the equity share adjustment. Okay, how to prepare the ledger account of equity shares. Fine. Now see here we have equity shares adjustment. It's really simple. So first you have to understand how to open the ledger account of it, what's the logic of the posting and everything, and then how you have to do everything, right? So let's see. Equity share capital account is a capital account. It's an equity account. It has credit balance. Debit means minus, credit means plus. Opening balance on the credit side, closing balance on the debit side, right? Yes. And one more important thing, equity share capital account exists at face value. Regarding shares, debentures, preference shares, what is there? There is issue price, there is face value, there is premium, isn't it? So the cash plays its game on issue price. Okay, how much cash has been received, yeah, and buyback price also, or redemption price, isn't it? How much cash has been paid, that's the thing. But the debenture account, preference share account, equity share capital account, these accounts always exist on face value. You have to understand the difference about this. Okay, so see here, let me just show you. Buy balance, B by D, opening balance, and then here you will take closing balance, right? So when equity share capital will increase, let's just say in the balance sheet you have two balances, opening balance, closing balance. Let's just say it has increased from opening to closing, it has increased by 1 lakh. Let's just say why it will increase. It will increase because you have issued new shares, right? So equity share capital is increasing because you have issued new shares by bank. Is it clear? Now here what you will have, here you will have only face value. Let's just say for example you have issued shares worth 1 lakh rupees, right? So 1 lakh will appear over here, face value 1 lakh. But let's just say you have issued at 20% premium, so that 20,000 extra will not appear over here. It will not come over here. It will go in securities premium account. So when you will do cash flow statement, you have to be very careful. When you will take in financing activity, proceeds from issuance of share capital, you have to take how much? Can you take 1 lakh over here? Here it's showing 1 lakh. Can you take 1 lakh? No, 1 lakh is just face value. You have to take 1,20,000 over here. Is it clear? That's what the devil is. This is the devil, the examiner. He's killing you. Do you understand? Yes. And then equity share capital can also increase if you have issued bonus shares. If you have issued bonus shares, then capital will increase. But understand, bonus issue is a non-cash thing, right? It's a non-cash item because there is no cash flow behind it. It's just reserves have been converted into equity shares. Is it clear? Yes. And then debenture, what is this? See, equity share capital can also increase if you redeem the debentures by way of conversion. Debenture holders are there. You are supposed to pay them cash, but they are convertible debentures, right? So you gave them equity shares and you said cancel the debentures, you have got equity shares, you are becoming equity shareholders, right? This can also happen. So in that case also equity share capital will increase and debentures will be cancelled. Yeah, to debenture holders you have given the shares. Is it clear? So in both of these cases, bonus as well as conversion of debenture into shares, in both of these cases cash flow is not involved. These things will not affect cash flow statement. Is it clear? These are non-cash transaction, will not affect the cash flow statement, bonus issue and conversion of debentures into equity shares. Fine. Okay, understood. And then I told you now, here only face value will exist. You have to look into securities premium as well. And 1,20,000 you have to take in the financing activity. You will add. Okay. You will add, right? You have issued shares, you're getting the cash. Fine. So see here, shares are usually bought back at premium and also issued at premium. That's what I said. But in equity share capital, only face value will exist. So what you have to do, you have to look at the issue price, which consists of face value as well as securities premium, right? And that's how you have to prepare the cash flow statement, by looking into those figures, okay? Because they represent the cash. Now, when equity share capital will decrease, let's just say opening balance, closing balance is there in the balance sheet. From opening balance to closing balance, let's just say there is a decrease of 1 lakh. Now, why that decrease happened? It means you have bought back. It means you have bought back the equity shares by paying the shareholders. You have to pay them, right? So that's what equity share capital have been bought back. It has been decreasing and cancelled because you have bought them back by paying the shareholders the money. But you have to pay what? Can you pay the face value only? No, you can't pay just the face value. You have to pay the price more than the market price, right? So that's a huge premium that you have to pay. So here only face value will appear. Here only 1 lakh will appear. Maybe they have paid 70% premium or 60% premium, right? So let's just say 60% premium. Here only 1 lakh will appear, the face value. Remaining 60,000 will be there in premium on buyback account. So you have to look properly the buyback price or the ratio, the percentage, and take entire 1,60,000, not just 1 lakh, 1,60,000 and deduct in financing activity. Otherwise, the examiner will kill you. Okay, is that clear? The devil is there. See here, buyback of shares. How much will you take? Can you take 1 lakh over here, just the face value? No, you have to take the buyback price, the whole buyback amount, that is 1,60,000, just for an example. Is it clear? This is how you do the adjustment of equity share. Simple and straightforward. It's not difficult. Now the same concept is there for preference shares, for debentures also. They will also exist at face value, and if you are doing redemption, if you are issuing, then same sort of situation will be there. Yeah, we issue at premium and we buy back at premium. Is that clear? Simple. You understood this? If you have understood this, then you have also understood the debenture and preference share treatment also. So when you will solve the question, you will be easily able to get that also, right? Okay. So now there is just two little adjustment. So let's just see that. Now see here, we have grant received adjustment. It's really simple. Grant received means the money that we get as an assistance from the government, right? So there are two reasons why we can get the grant. The first is for capital projects, right? And the other one is to meet revenue expenses. Is it clear? Two types of grant can be there. Now, if we are getting for capital projects, then what the ICI does is, right now in the module, ICI just consider that as an investing activity. Okay, in the direct method or indirect method, what will happen? It will be added in investing activity, right? Why? See, understand. The logic is, see, capital project means what? We are investing in the asset. Yeah, it's an investing activity, outflow. Yeah, we are investing in a project. Is that clear? So any grant received related to that, that will also be an investing activity. Is it clear? So what you have to do is, see, let's just say for example, we have received 1 lakh grant for capital projects. We'll go to investing activity. We'll write over here grant received for capital projects 1 lakh. Is it clear? Direct or indirect method, same treatment has to happen in investing activity. Fine. And then see, if you are doing indirect method, one more step can be there. If the question says that, you know, grant received for capital project has been amortized. 1 lakh we received. Let's just say in this year we have amortized 40,000. Okay. So that means it has been taken to PNL. Amortized means it has been taken to PNL. It has been added in PNL. So now what you have to do? You have to reverse. Okay. In indirect method, yeah, because it is not of operating family, right? Grant received is of investing family. Just now we saw. So that is what we have to do. We have to reverse. It's a non-operating item. Yeah, it has been amortized over here. Let's just say 40,000 as I said. So 40,000 you will reverse. Okay, you will subtract. Is it clear? That is what you will do. If such grant is amortized in PNL, then reverse by amortized amount in operating activity. Fine. Okay, clear. That's what you have to do regarding capital projects. And then, for example, let's just say we have received grant for revenue expenses. in that case, understand you have to just add in operating activity under direct method. Okay, because in direct method you do what? Pick and drop. So that is what you have to do in the direct method. But in indirect method you don't have to do anything, because already it would have been gone to P&L. Mostly it would have been gone to P&L, so you will not do anything. Is it clear? If already transferred to P&L, you don't need to reverse and all. Why don't you need to reverse? Because the grant which is received to meet revenue expenses, that is already an operating item, that is not an investing item. So it would have gone to P&L, you will not do anything about it. Is it clear under indirect method? Fine, clear. But now there is one more opinion, that grant received can also be taken to financing activity. Yes, that is also possible, that is also correct. Okay, if you go deep into this, see, before ICI also in the material used to take the grant received for capital project as a financing activity. The idea was that, see, we have not started spending on the the project, and we have got the grant, so it's like a finance that we are getting. So they used to consider as a financing activity, inflow in financing activity. But right now in the latest module, what the ICI is doing, ICI is considering it in investing activity. So that is why we will also consider it as an investing activity inflow. Is it clear? Okay, so that's regarding the grant received adjustment. Now see, here we have our last adjustment, premium on redemption of debenture or preference shares written off. It's really simple. Understand, this is also a bit tricky for the students. So you have to understand what used to happen earlier was, ICI used to say this is an appropriation item. Appropriation item means in statement of profit and loss, we write this premium on redemption of at last, yeah, in the appropriation. It is not part of profit and loss account. Fine. So when we start from retained earnings figure, the profit after all adjustment in indirect method, then only we used to reverse this. Yeah, usually it is deducted, so to reverse we will add it back, isn't it? Yes, and it used to happen only when we start from retained earnings. See here, if it is an appropriation item, reverse in operating activity only if you start from retained earnings. If you start from net profit after tax or before tax, you didn't use to reverse it because it's part of appropriation. Is it clear? But now if you will check the study material right now, the latest one, what the ICI is doing is, ICI is assuming that this has been written off inside the P&L account. It has been charged to profit and loss account. So where is it sitting? It is not sitting in the appropriation. It has not been deducted in the surplus figure. No, what is happening is this premium on redemption, it has been charged to profit and loss. It is existing over here. It is sitting over here. It has been deducted over here, charged to profit and loss. So that means now if we prepare indirect method cash flow statement, what we need to do is we will have to reverse this premium on redemption always, whether you start from third priority, second priority or first priority. Okay, where you have to take it, you have to take it over here. Reverse non-cash and non-operating items. Premium on redemption of preference share, let's just say it's 5,000. Premium on redemption of debentures, let's just say it's 10,000. 10,000 will come over here, you will reverse it. You will find questions in this ICI study material regarding this. Okay, they are taking it over here, reverse non-cash and non-operating items. Is it clear? Fine. So when it is charged to profit and loss, always you have to reverse it in the operating activity. In silent question, ICI assumes it is charged to P&L. What is charged to P&L? Premium on redemption. Is it clear? Simple and straightforward. Okay, I hope you have understood this. Okay, this is very simple, it's not difficult, and here we can conclude our concept and this format video. Right, from the next video we can start solving the big problems on indirect method, because direct method is really simple. First let's just focus on indirect method. Direct method you will easily understand. Yeah, so that's all for this video. I hope everything is clear. If you have any doubts, please take screenshots and ask me in Instagram. You can also comment down below, right? And I will upload the notes on the Telegram channel so that you can properly understand and revise everything, because lots of things have been covered in this video, in this 3-hour long video, isn't it? Yes. So yeah, the notes will be very important. You can go to my Telegram channel. I will put the links in the description below. It's Saheb Academy 7. Okay, right. So that's all. See you in the next video. Bye.